Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
2 hours away from the opening bell. Welcome to the program. Equity futures right now positive across the board, up by 0.5% on the S&P. On the Nasdaq 100, up by 0.6%. On the S&P, closing out yesterday for the best day, biggest day of gains since February. Switch up the board, turn the page, and get into the bond market. Yields look like this on a 2-year and a 10-year. Yields drifting higher, up by 2 basis points on a 2-year to 4.28 after dropping about 50, as Lisa mentioned earlier in the program, down 50 basis points through the month of July at the front end of the curve. And just to get to foreign exchange, just want a sneak peek of what sterling is doing after that Bank of England rate cut 30 minutes ago. Sterling down to about 127.67. We're negative on that currency pair by 0.7%. Under surveillance this morning, Kamala Harris search for a running mate nearing an end. Pennsylvania Governor Josh Shapiro meeting with Harris's team as some labor groups speak out against Arizona Senator Mark Kelly joining the ticket. Harris is expected to make her pick by the middle of next week. Elsewhere, tensions rising in the Middle East. The New York Times reporting Iran's supreme leader has ordered a retaliatory strike on Israel for killing Hamas political leader in Tehran. The report sending oil higher for a second straight session. Brent crude up here by 0.8%. And I want to turn to this story. Barclays unveiling a share buyback plan worth more than $960 million US. This coming as the British lender reported better than expected second quarter investment banking revenue and boosted its guidance for the full year. Joining us now is the Barclays CEO, CS Venkatakrishnan. Venkat, it's great to catch up with you, sir, once again. I will go through the numbers so you could be modest and you don't have to. Equity underwriting booming, equities trading up nicely. The stock is up by something like 50% year to date. Venkat, there was some weakness in FIC trading that I want to get to in just a moment, but let's start with the position of strength you're in. Equities trading. Where did that strength come from, Venkat, and do you expect it to continue through the year?
Well, thank you for asking me to join the program. I'm very grateful to be here. And as you say, we are in the process of delivering on the investor plan that we laid out in February of this year, which was to have a simpler, better, more balanced bank, a bank that returns 12% ROTE and above by 2026, returning about £10 billion to shareholders by 2026 and more, and then rebalancing the bank so that the investment bank goes from around 60% of the bank to around 50% of the bank. One part of the investment bank is our markets business and the equity business, which you highlight. We've always had a great strength in equity, and I think as equity markets themselves have gone through the changes that you've seen since the start of this year, our traders have been able to capitalize on client demand, on increasing volatility, and providing the kind of innovative derivative solutions clients seek from Barclays. And I do expect, as market volatility keeps apace, for our performance in equities to continue.
While we're seeing that same strength in FIC trading, Venkat, I wonder what you can do to turn things around in that particular part of the business.
So within FIC, we are a very, very strong credit house, and typically in the top 3. One of the reasons in FIC that in the market and for us it affects us maybe a little more is that credit spreads have been muted and credit volatility has been muted. Quite the opposite case from equities. In European rates, which is an area of growth for us, we've improved from the first quarter to the second quarter. And securitized products, which is an important part of fixed income, is growing from strength to strength. So our FIC performance is improved from the first quarter to the second, and I could expect to continue to see more of that improvement as the year goes on.
Venkat, we've been having a debate for several months now. Are rate cuts good or bad for banks? Are rate hikes good or bad for banks? Are rate cuts broadly good or bad for your profitability at a time when a lot of people are expecting them globally?
So what I would say is very special about this rate cycle is that what we're expecting is not a spate of cuts, but fine-tuning adjustments. So the answer to your question is I don't think they'll make that much of a difference to a bank like ours or to the large banks. You know, my colleague Ajay Rajadhyaksha, who runs in macro research for us, often says a rate cycle is when you go up in an escalator, meaning slow cuts, and come down in an elevator, slow rises, and then fast cuts coming down in an elevator. What we've seen this time is we went up in an elevator, meaning very fast rate hikes, and we may be coming down by the stairs. So you saw a fine-tuning adjustment by the Bank of England this morning. You saw the Fed pause, but they're indicating they may go later this year. All of these things are just trying to adjust interest rates by a small amount because real rates have crept up at a constant inflation, which is 2%, which is low, but it's just trying to overcome the slight impediment of rising real rates. So I don't expect this to have much of an effect on the banking sector, if any, and certainly we are not changing the way we view the world because of this modest rate cut.
In the meantime, you say that you are on track to achieve £1 billion in cost cuts. There is sort of some swirling questions around where those cost cuts are coming from. Is it simply just being more efficient in certain sectors? Is it ongoing job cuts? What are you executing?
So we did £1 billion worth of structural cost actions last year. We're seeing, A, the benefits of some of that. B, we're seeing the benefits of a greater focus on productivity and efficiency in the way in which we run the bank. And what we're also seeing is the results of investments which we have made, particularly in markets, particularly in trading technology. I'm talking to you from our equity trading floor in London, and the way we have increased our market share in electronic trading here in Europe and in the US is all a result of past investment. You have to continue to do it, but it's probably at a slower pace than we did in the last couple of years. So it's efficiency and better investment.
Can I ask you about the advisory business with that in mind? How is that going? How's the turnaround going in that unit?
So investment banking, we've done, as you see in the results in the banking side, quite strongly. Equity capital markets did very well. Advisory is improving. We still have a little way to go. We are seeing deal volume pick up. We're seeing our backlog increasing. And I think over time, as some of these ideas fructify, you will see an improvement in the advisory numbers.
I'd love your view, Venkat, on how business is going more generally as you look across corporate America and corporations across Europe. I can share with you some of the comments we've heard from corporate America over the last couple of weeks. From P&G, they're seeing slower price increases. Kimberly-Clark also saying the same thing. McDonald's are talking about the first sales slide since 2020. Pepsi saying the consumer is becoming more challenged. You've got a massive consumer business as well with the Barclaycard business. When you look at corporations and the consumer, are you seeing the same kind of slowdown, Venkat, from your vantage point?
So what we are seeing, and which is good for the credit performance of banks, is we are seeing both consumers and corporates focusing on efficiency and managing their budgets more carefully. So if you are in the consumer business and if you're a consumer-oriented company, what you will see is therefore a lack of pricing power and then people economizing. We see that in our own customers. What that means, though, is that even though employment is still very strong both in the UK and the US, people are managing their budgets more carefully, which is one of the reasons why, by and large, credit impairment costs for banks have been relatively well controlled. So it's good for the consumer to do this and manage their budgets. It's good for their lenders because they're seeing less signs of consumer distress. It's good, however, it's for the economy, however, there are winners and losers. And that's what you're seeing from some of the people you're quoting.
Are you seeing a big difference in terms of consumer strength globally, depending on the region? We've been talking a lot about how the consumer shows a lot of, I guess, restraint when it comes to spending, but more so in some of the sectors, more leverage to Chinese consumers. How much are you seeing Europe in a weaker spot than, say, the U.S.?
Well, I think the slowdown which we've seen in China is palpable. And what Chinese demand has done is affected sectors which were particularly exposed to them. You saw some of it in the fashion goods industry. And tech, of course, is a different situation because, the trade with China is being limited in tech for other reasons. But I do think that what you will see is people with that exposure to China being more affected. You've already seen it in the numbers, and I expect that you'll see that for some time to come.
How much does it affect where you're expanding or where you're not expanding?
Well, Barclays is first and foremost a consumer bank in the UK, a global investment bank, and also got a very strong corporate presence and a wealth presence. But all of that is very highly connected to London from Europe, from the United States, and then from India, Singapore, Hong Kong. We are not a major presence in mainland China, and so what we think is that the impact of what's happening in China is relatively more muted for us compared to other banks with larger exposures.
It does raise a question, though, about some of the tensions that have been coming to the fore politically, internationally, in terms of potential tariffs, potential restrictions, changing policies, the elections. How are you trying to get ahead of that at a time where there's a lot of policy uncertainty? And arguably, that's one reason why advisory and mergers and acquisitions hasn't been as robust as some people had expected it to be.
It's a very, very good point. And I think the big area where all that comes into play is cross-border M&A and cross-border transactions. You've even seen a slowdown of that within Europe itself. For us, it highlights one of the things which we've done, which is we decided very early this year when we did our Investor Day and made the decision towards the end of last year to invest £30 billion of risk-weighted assets in the UK. The UK has had its election. We've elected a business-friendly government. The transition has been smooth, and it points to the importance for banks like us to be in places with very clear economic policy, the good rule of law, growth, and stable governments and stable economic policies.
Venkat, the year is going well. Hopefully next time you're in New York, we can catch up again here in the studio. Appreciate your time this morning, sir. Thank you. The Barclays CEO, CS Venkatakrishnan. The Barclays stock is up by more than 50%. It's quite a year so far for Barclays.
They've also pledged £750 million being returned to shareholders, so quite big in terms of dividend payments.
Let's get you an update on stories elsewhere. We can cross over to Danny Berger for more. Hey, Danny.
Hey, John. The Bank of England has cut rates for the first time since early 2020, dropping the benchmark by 0.25% to 5%. The decision was a 5-4 split. Governor Andrew Bailey cast the winning vote to cut. In a statement, Bailey said inflation had eased enough to cut, but they need to, quote, make sure inflation stays low and be careful not to cut interest rates too quickly or by too much. And another day, another record for NVIDIA. The chipmaker added $329 billion in value in Wednesday's trade. That is the largest gain for any stock in a single day. It's a record that the company has set many times over the past few months. The 13% rally yesterday comes a day after a 7% rout that wiped out more than $193 billion. In July alone, the shares have seen a lot of swings and drops that accounted for half of the 8 biggest market cap wipeouts on record, according to data compiled by Bloomberg. Bill Ackman's Pershing Square has withdrawn its U.S. IPO for a closed-end fund. Ackman had bet that his wide following on X would help him raise $25 billion in the IPO. But faced with difficult questions from investors, he cut the target to $4 billion and then $2 billion in just over a week. Pershing Square says it will reevaluate its structure based on investor feedback and, quote, report back. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, moving closer to a rate cut.
If the market's already pricing in September with a high degree of certainty, what are you really waiting for at this point? Why take the additional risk of, the economy deteriorating further?
That conversation up next. Live from New York, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bit of breaking news for you in the last couple of minutes, some important breaking news as well, so allow me to share some of that with you. I'll go through it carefully, in detail. Russia releasing Wall Street Journal reporter Evan Gershkovich and former U.S. Marine Paul Whelan as part of a major prisoner swap with the United States. This according to people familiar with the situation. As I'm sure you all know, these two men have been jailed in Russia on espionage charges that they and the United States have been denying. They're en route to destinations outside of Russia. An important development, Lisa, in the last couple of minutes.
In return, we don't have a lot of details yet. The U.S. and its allies are expected to return prisoners to Russia that they hold under this deal. Just to give you a sense, Evan Gershkovich has been jailed for several years now after being arrested on espionage charges, and has been a real cause among journalists in particular to get him released, and Paul Whelan has been in prison for much longer.
Those talks, as Lisa suggests, have been ongoing for quite a while. Just to confirm that information we've just received in the last couple of minutes, according to people familiar with the situation, Russia releasing Wall Street Journal reporter Evan Gershkovich and former U.S. Marine Paul Whelan as part of a major prisoner swap with the United States. When we get more detail, we'll bring it to you. Under surveillance this morning, moving closer to a rate cut.
The market's already pricing in September with a high degree of certainty. What are you really waiting for at this point? Why take the additional risk of, the economy deteriorating further? So, at the end of the day, it's probably not going to make a lot of difference. But I think, given the fact that the market expects the Fed to cut, once that decision is mostly made, and I think you heard today it was mostly made, then why are you waiting?
Why are we waiting? Here's the latest. Investors turning their attention to the data following yesterday's Fed decision. The July payrolls report due out tomorrow and CPI coming in just 2 weeks' time. Fed Chair Jay Powell waiting for the numbers before committing to a rate cut. The former Kansas City Fed President Esther George writing this: I found the chair leaned pretty clearly to confirm market expectations for a September cut. While September looks like the meeting to take this action, I think there's room to be patient. Esther joins us now for more. Esther, wonderful to catch up with you. It's been far too long. Thank you for being with us. I want to talk about that word you've used, patience. What underpins that patience? Why should we have that patience?
Well, good morning. I think my view on this really comes from the fact that we are looking at an economy that is growing, and by the reads of the second quarter, growing well above its sustainable long-run growth. You've got a strong labor market, and you still have elevated inflation. And I think that combination reminds me that the Fed's mandate is a long-run objective. And just as we saw earlier this year, the market had priced in a number of cuts only to have to pull back on that. So the central bank's job is really to pay attention to the data. And as that gets closer, of course, that's going to be more difficult for them, and they recognize that.
How big is the risk that we take that strong labor market for granted?
Well, I think you're always looking at this because we don't know with any great certainty where that equilibrium rate is for the labor market. Obviously, we came out of the pandemic during that recovery with a very tight labor market. And so as we watch it normalize, the space between normalization and weakening is one that policymakers are going to be very attentive to. So we'll get a report tomorrow. It will give a clue. I don't expect it'll be definitive and by any means around that, but it is the collection, the aggregate of these reports that begin to give the committee a better sense of just where that labor market is right now.
Esther, do you get the sense that this Federal Reserve still embraces the idea of transitory in that basically the inflation was largely due to the pandemic? It's come off the boil, and now some of the ramifications, the ripple effects, are just being worked out of the economy.
I think that could have a lot to do with it, Lisa. You did see tremendous supply adjustments, and it had been some time since we'd had to pay attention to the supply side of the economy. So as we watched supply, and that was true on the labor side, certainly good on the goods side, begin to adjust, that creates a challenge, I think, for the committee and understanding just how restrictive is our policy. How do we understand when the economy is approaching an equilibrium? And I think, as they've noted, they are close. Those risks are coming into better balance right now. And now judging how tight their policy is relative to the steady state of the economy is their real challenge. And we heard that yesterday, too soon versus too late in making adjustments to that.
It seems like the market really believes that the risks at this point are greater, potentially on some sort of deterioration in the labor market than an increase, a surge in inflation. I'm wondering if you think that maybe the Fed would have been prudent to push back just a little bit on that based on what you're seeing, considering that you believe that maybe there should have been a little bit more patience, kind of a little more discipline imbued on the market.
Well, I would agree that the labor market, again, is coming into better balance for this committee. And you will have to look at some of the subtleties that come in underlying that labor market in terms of the levels of activity and the momentum that you see there. But at the end of the day, the committee is faced with an elevated inflation rate relative to the target they've established and the credibility they seek around getting back to that. And in the long run, as we've heard many times from both the chairman and others, that sets the conditions for a healthy labor market long run. So yes, near term, they're going to be watching a lot of those signals. But the real issue, I think, at the end of the day is their inflation mandate.
Esther, I'd like to do two things. I want to share a quote with you, and then I'd like to lean on your experience on the committee. You've got plenty of experience of understanding how all of this works behind closed doors, the stuff that we don't see. This is what Evercore had to say. We think in practice it's not very data dependent and view the cautious evolution of the statement as intended to carry hawks along and avoid dissents. Esther, in your experience, when you hear stuff like that, how true is that? How do things come together on the committee?
Well, it's true. This is a committee that is consensus driven. They must make a decision. And the nature of a large committee with differing views is to try to achieve consensus at some point. That doesn't mean you always get unanimity around that decision. And I think anytime you begin to approach what looks like, I think in their words, better balance, things coming into balance, the decisions get more difficult. It's not as clear cut as it was when you know you have to ease, or it's not as clear cut when you see an inflation problem emerging that you have to address. And so I suspect there is a challenge within the committee of trying to reconcile views and to try to bring a solid consensus to whatever the decision will be at their next meeting.
Esther, this was wonderful, and hopefully the team gets to see you in Jackson Hole. as we used to. Esther George there, the former Kansas City Fed president, on the latest Federal Reserve decision from yesterday and the news conference with Chairman Powell. As we take another step, another small step towards a rate cut in September, and that committee comes together. I know we often complain about getting too much Fed speak, but we would like some Fed speak, just to get an idea of how big the range of views is on the committee going into September.
What was that? Just one more time?
We would like a little bit more Fed speak.
I'm not used to hearing
such
such
quiet.
things.
I miss it for a little while, then it all comes back, and then you're all like, oh, that's too much. Slow down. Slow down.
Welcome to human nature. It does seem like it might be good to see where the daylight is and just how many of those small minority were really calling for a rate cut at yesterday's meeting, because that was something that was nodded to. Look, this is a different kind of Federal Reserve Committee than certainly the Bank of England with their dissent and some of their discussions. But the debate is similar, which is balancing these two risks. I thought it was interesting that Esther George was talking about caution and how they should have had perhaps a little bit more caution. I'm curious, where the balance of risks is within the committee that sort of is a dated point that could pull them away from September, or is it basically a lock?
What we heard there is a former official who thinks they have reason to be patient and to wait. We heard from another former Fed official, Bill Dudley, who has a completely different view on all of that. I think what separates those views is a view on the labour market. And we keep coming back to the same place, the same destination. It's going to be payrolls tomorrow morning at 8:30. It's going to be jobless claims again at 36 minutes time, in 36 minutes time at 8:30 Eastern this morning. That's going to be the difference between having a view on whether they have time and having a view on whether they're running out of it.
And whether the risk asset markets can continue to rally in the face of rate cuts, or whether rate cuts signal something deeper. Bill Dudley pointed to the SOM rule, and he explained in a little more detail why the SOM rule was so important. And he said there is this trigger point in economies where an increase in unemployment begets more weakness. Basically, people get laid off, they feel bad, they don't buy as much because they don't have the budgets to do so, and then spending goes down, and then layoffs increase, et cetera. It becomes a spiral, a self-perpetuating spiral. That's why he is concerned about that, and that is the reason why the unemployment rate is going to be really key tomorrow.
Adil Dutt is right to point all of this out repeatedly. He's done again and again and again. Are we at the point where you can make a stronger argument for higher unemployment than you can for higher inflation? And if you are, and you're in the risk management business, then isn't the decision you've got to make here one that should be lower interest rates? That's the Neils of this world. They're the Neils of this world. That's what they think right now. That's a very strong view.
At the same time, when you take a listen to Barclays or Bank of America CEOs or Torsten Slok of Apollo, they look to year-over-year comps that get a lot more difficult later this year. And frankly, take a look at housing. If you cut rates enough, just think about how much demand there is in the system to come back on, especially if the economy is still strong. There is that other argument. It's just gotten a lot quieter recently.
You've got to have some sympathy with the Federal Reserve. We've all been humbled post-pandemic when it's come to this economy. How many times it's moved in directions we did not expect, or rather not moving at all. You go back 2 years, you take a snapshot of the program we did in Jackson Hole in August 2022, and if you just listen to a lineup of guests, whoever they might be, that month, we're all talking about pain, the prospect of unemployment going too high, aspirational Fed forecasts, they can't possibly do this, and here we are with unemployment around 4%.
Recession was the base case heading into 2023. And that's where we are now.
We could be humbled again. In the third hour, Jason Thomas of Carlyle, Wamsi Mohan of Bank of America, Subhadra Rajappa of SocGen, and Eric Cantor of Moelis & Company. That's all still to come. This is Bloomberg.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating And then you'd start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Reduction in our policy rate could be on the table as soon as the next meeting in September. We just want to see more and gain confidence.
This is a lot of good news. I mean, this is a chairman basically saying, without saying it, we've achieved the soft landing.
Put it this way, I think they think they're going to go in September.
We'll see what happens as we roll into September. We're still very much expecting 25 basis points in September.
I think there's a good possibility that you'll see a unanimous vote in September for a 25 basis point rate cut.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
If you missed the coverage yesterday, just in a word, September. It's basically the takeaway from yesterday at the news conference with Chairman Powell. We'll see you in September. We'll see him again, of course, in Jackson Hole, Wyoming, later on this month in August. From New York City this morning, good morning, good morning. The third hour of Bloomberg Surveillance begins right now. And the morning started already with the first interest rate cut since the pandemic from the Bank of England about an hour ago. Let's turn to the price action. Equity futures right now on the S&P, kicking off the month of August with equity futures positive by 1/3 of 1%. On the NASDAQ 100, up by 1/3 of 1% also. July was pretty rough for the NASDAQ until right at the end of the month. And then we absolutely ripped into month-end, Lisa, and we were supported by a major rally on NVIDIA.
Yeah, especially after what we got from AMD, which indicates the spending cycle has not dimmed when it comes to AI. If anything, it is only accelerating. Just think that the same liability that caused Alphabet to lose some steam is exactly what is supporting NVIDIA, which is that investment cycle, that CapEx is exploding, and companies more broadly think they cannot spend enough, not that they want to restrict their CapEx spending.
Yeah, the numbers have been absolutely phenomenal, and I think we keep returning to that quote from the Alphabet CEO. The risk of underinvesting is greater than the risk of over-investing, and that's a quote that I think we heard echoes of. I think it resonates with the likes of Mark Zuckerberg over at Meta. We'll talk about those numbers a little bit later this morning. I want to turn to the day ahead, and I want to focus on payrolls tomorrow and what we're about to see at 8:30, which is jobless claims. Every conversation we've had, regardless of your view on the Federal Reserve, comes back to one thing. It comes back to the labor market. If you think we've got more time, it's because you think this labour market's strong. If you think we're running out of it, it's because you think this labour market could potentially get weaker. Jobless claims at 8:30, then later on this morning, ISM manufacturing, then we could talk about earnings again after the close. Two big heavyweights, Apple and Amazon. But let's just sit on the labour market. It keeps coming back to the same thing, Lisa. It comes back to jobs in America.
Yesterday, we were speaking with Laura Rame of FS Investments, and we asked her, she was pretty confident that this market is strong and that actually the inflationary pressures are a little bit stronger than some people think that they are at this point. We asked her, what would change your view? And she said, if claims came in above 300,000, the expectation is for 236,000 in about a half an hour time. But that is the difference between people having a positive soft landing view and people saying, well, this is actually looking a little bit harder than that. And is the reason why that high frequency data point is taking on renewed emphasis at a time when there are plenty of questions around the accuracy of the data and some of the noisiness.
Let's get back to that calendar. Let's look at that again and we'll go through the dates together. The Federal Reserve meeting in and around the middle of September, towards the back end of September. Going into that meeting, this is what the lineup looks like. The data between now and then. Payrolls report tomorrow, CPI report a week or so later, August 14th. September 6th, we get another jobs report. September 11th, we get a CPI report. When we fill in the numbers around those dates and we get to that meeting in September, Lisa, how different do things look? When they look at the totality of the data, how much emphasis, how much weight will they have to put on the labour market by the time we get to September?
That's a great question. I think that's what people are looking at. I would just add to that in terms of a question, not answer it, because if I answered it, people could then throw spitballs at me and say, how could you have any certainty about anything as we wander around in a dark room with a blindfold on? There is going to be a question about what's going to be more important, the actual numbers themselves or the unemployment rate. The reason why the rates are taking on in renewed emphasis, not just because of the SOM roll, but because the employment market has grown so much. So you start to wonder, what is an acceptable pace of job creation, considering how much the population and the workforce has grown? And so how do we really measure weakness? I mean, these are some of the sort of fundamental questions people are asking themselves about markets that have been profoundly changed post-pandemic, and frankly, data that has actually become much more difficult to collect as well. It's something else that people talk about quite a bit.
Yeah, particularly for jobs, job openings. How real is that? Had a lot of people sort of put big question marks over that data point. I want to come back to the jobs we get later. So jobless claims, the estimate 236,000. That's the estimate in our survey. Previous week, 235. Just another sneak peek, a preview of payrolls in our survey. The number at the moment, the median estimate is 175. As you all know, the previous month was 206. And to Lisa's point, I think for a lot of economists right now, if they could take one data point, one number, for Friday, it would actually be the unemployment rate. And we're looking for that to come in at 4.1% again. That is the median estimate. The likes of Citi looking for that to move a little bit higher to 4.2. The previous month, of course, 4.1%. I want to turn to the broader price action. Equity futures shaping up as follows on the S&P 500, going into the cash open. The first trading day of the month of August. I've got no idea what happened in July. Equity futures up by 0.4%. Yields are higher by 3 basis points after a monster move lower over the previous 5 days. 5 days of gains for a 10-year Treasury. Yields dropping 25 basis points in just 5 sessions. If you take the whole month of July at the front end of the curve, Lisa mentioned this number a little bit earlier, the 2 years dropped 50 basis points in the month of July. Let's see what August has got in store. We're back down to the low 4s, the very low 4s on a 10-year yield. Coming up this hour, we'll catch up with Jason Thomas of Carlisle as stocks rally on rate cut hopes. We'll speak to Wamsi Mohan of Bank of America, looking ahead to earnings from Apple, and Eric Cantor of Moelis & Company on why Wall Street isn't playing a central part in this year's presidential election. We begin with the big issue. Stocks get their big dovish pivot as Fed Chair Jay Powell sets the stage for September. Jason Thomas of Carlisle saying this: the case for a September rate cut is very simple. As inflation falls, policy becomes tighter. If base rates remain unchanged, with cooler labour markets and a modest slowdown in nominal growth, there is no reason for tighter policy today. Jason joins us now for more. Jason, it's great to catch up with you once again. Let's talk about that base case, September, like so many people. It's what happens next where there seems to be some division and confusion, the ultimate destination here, Jason. What do you think of the pricing beyond September for the next 18 months or so?
Well, I think it's very aggressive. I think the big lesson that we've learned over the last year is that policy has not been as tight as many suspected. Entering the year, there was, of course, expectations for 6 or 7 rate cuts. That was predicated on the idea that a real interest rate of 2% would absolutely smother economic activity. Of course, that's not what we've observed. And I think learning from this experience would suggest that the Fed is going to behave very cautiously. I think in general, the less certain you are of the destination, the terminal rate in this case, the more slowly, the more cautiously you're going to proceed in that direction.
You put a comment out in your recent commentary, Jason, and I'm still trying to wrap my head around it, so I'd like your help. You wrote, it may be time for investors to hold two seemingly contradictory thoughts in their head simultaneously. The time for rate cuts has arrived, but financial conditions are too accommodative for the Fed to deliver the scale of easing anticipated by some market participants. Can you explain what the Fed should do with that and what that exactly means?
Well, so since the start of the year, policy has effectively tightened by 50 basis points. That's just the decline in core PCE inflation observed in the first 6 months of the year. So I think there's a very strong case for two cuts, September and December. Thereafter, things get much murkier. And so really that's what I'm suggesting. You heard a lot of talk yesterday at the press conference about normalization. Are you just cutting rates once, or are you normalizing policy? And I found this odd because we don't really know what normal is in the new environment. We, of course, have massive budget deficits. I don't mean to catastrophize those, but we do have to appreciate that right now, the after-tax incomes of households and the corporate sector are about $1 trillion larger than they would be if you had a fiscal policy that was stabilizing debt-to-GDP ratios at reasonable levels. Secondly, you have the largest concentrated capex boom we've seen in this country since the telecom boom of the late 1990s. You just mentioned the quote yesterday from Alphabet about the risk of underinvesting. This seems to be something that's going to persist. Finally, you have deglobalization, or at least the presumption that more of what we consume in the U.S. is going to be produced here, which is, of course, going to lead to potentially some upward pressure on prices, the potential for supply shocks, more volatile inflation. If you put all of this together, it sets up for, on the one hand, certainly some rate cuts coming at the end of this year, September again, probably December, but then thereafter, you could have rates that essentially settle in at 4.65, 4.5, somewhere in that range.
Are you saying that that's a more likely neutral rate at this point, and that the market has gotten way ahead of itself in terms of estimating that it's something closer to 4 or even 3.5%?
I think you have to ignore the experience of this year, of the last 18 months, to think that the neutral rate is still 50 basis points in real terms. And so, again, this is a situation where there's a lot of uncertainty. To be so wedded to a neutral rate at these low levels, at levels that persisted between the global financial crisis and the pandemic, is to ignore recent experience. I think that would be very unwise for the Fed to take that sort of approach.
Well, Jason, this goes to a deeper question, really, which is essentially a lot of people are betting that rate cuts are going to support the next leg of growth in the U.S. economy. Are you saying that that's not a lever that they can really pull in the same kind of way, that maybe some of those inflation-sensitive strategies look better, and some of the ones that rely on inflation coming off and the Fed cutting rates are maybe a little frothy?
Well, I think that in general, if you look at risk premia in the economy, if you look at where credit spreads are today, they're tighter than they were, again, at any point since 2007. If you look at duration risk premium, where's the 10-year in relation to the expected path for Fed funds over the next 10 years, it's effectively zero. If you look at estimates of the equity risk premium, based on consensus forecasts for dividend or earnings growth, it also looks very, very tight, very, very narrow. So, I think that this all suggests that you have a market that is really priced for perfection to a large extent. And going forward, if we have some really unfortunate, unforeseen developments in the economy, of course, the Fed, with base rates at 5.3%, has a lot of firepower, could do a lot to stabilize economic activity. But if things persist as they do today, again, I think base rates that, I would use as a baseline, nothing that is lower than 100 basis points from here as a reasonable expectation should growth persist.
Jason, I don't want to put words in your mouth, so I just want to ask for your opinion directly. Do you think the Federal Reserve's getting it wrong?
No, I think the case for rate cuts today is very clear.
Not the
You
September
see
call, just
labor
to jump
market-
in, Jason. I just mean
Yeah.
in terms of how they think about the economy, because I'll tell you what I heard in the news conference yesterday, and he didn't say this directly, but I think he gave us a lot of clues. He almost frames the inflation shock coming out of the pandemic as due to one-off factors that are ultimately fading. And what I hear from you is that actually some of these forces are going to hang around. Do you think he's getting that piece of it wrong?
Well, there was, of course, an element of inflation that was transitory. But you know, I'm surprised, given that the second and third order effects that we saw, that people would still be of this mind. What we learned, I think, in the inflation shock is that when you have shortages, you have a response to that. People over-order. If they're expecting 100 units of a component or part and they fear getting cut back, they order 200. You start seeing hoarding. You start seeing downstream price dynamics that are very difficult to control. And again, I think when we compare today relative to 2019, we see both with the fiscal deficit, with the CapEx boom that certainly was not occurring then. I mean, you have fixed industrial investment in the United States right now that's 3 times 2019 levels. And then again, the shock from the tariffs on China in 2019, most people expected they would be rolled back. Vice President Biden at the time suggested that this policy was unwise. It was harming American consumers and farmers. Now, no one is speaking like that. In fact, the direction as it relates to trade frictions, I think, is only in the direction of war.
Yeah.
So, you know, again, it's very important to, when we contextualize the current situation, when we account for all of these massive changes relative to 2019, I think you're left with much more upside risk to inflation should you act more should the Fed act more aggressively over the next 6 to 12 months than perhaps many perceive.
Jason, you said that if growth continues, then this market is somewhat priced to perfection. Which market in particular is priced to perfection? And is it sort of a good news is bad news and bad news is bad news type of paradigm that we're entering into?
To be clear, I think that when you look at indexes, if you look at the NASDAQ, if you look at the S&P 500, because so much of the gains have been concentrated in, of course, a very small number of stocks, and you look at the aggregates and you look at the equity risk premium in the index, then you say that it's priced to perfection. Now, if you look at the broader U.S. stock market, you see many stocks that look quite reasonably priced because they've not participated to the same extent. Many stocks where you've seen earnings growth far in excess of price appreciation, of course, implying that valuations have come down, in some cases, quite materially. So you know, it's a market that I think is gravitating from momentum trades, very focused on those stocks that, you know, actually quite benefited in many cases from higher rates. Many of these mega cap companies, of course, have negative net debt. And of course, they have large cash piles that are earning floating rate interest that is in excess of their relatively low fixed rate liabilities. They're also, of course, generate so much cash in the near term that, you know, the effects of rates isn't so great. So it's quite rational that the market rotated into those stocks. And the valuations now have reached levels where, you know, I think on a prospective expected return basis, people have to start looking elsewhere.
Jason, this was deeply thoughtful. One of those conversations I'm going to re-listen to a little bit later on this afternoon. Jason Thomas of Carlisle. Jason, thank you. Appreciate it. A lot to work through there on the backdrop for the economy, what he thinks is going to happen, and where you want to be in financial markets as well. Let's take the opportunity to get you an update on news elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Russia is releasing Wall Street Journal reporter Evan Gershkovich and former U.S. Marine Paul Whelan as part of a major prisoner swap with the U.S., according to people familiar. The men had been jailed in Russia on espionage charges that they and the U.S. deny. They are currently en route to destinations outside of Russia. Under the deal, the U.S. and its allies will return prisoners to Russia that they hold, the people familiar said. Toyota shares falling in the Japanese session, 8.5%. The auto giant reported mixed results for the second quarter. Global sales fell nearly 5% in the first 6 months of 2024, most prominently in China and Japan. Profits still climbed overall, though, thanks to the weak yen and robust demand in North America that boosted sales. Despite headwinds, including a government probe into Toyota's manufacturing process, analysts still expect record profits this year. And U.S. swimming icon Katie Ledecky has added another gold medal to her illustrious career after dominating in the 1,500-meter freestyle. The gold ties Ledecky with the most medals ever by a female swimmer. She'll be competing to take sole possession of that record later today. The 27-year-old confirmed after the race that she has no plans of retiring and wants to compete in Los Angeles in 2028. And that's your Bloomberg Brief. John.
A phenomenal athlete. Danny, thank you. More from Danny again in about 30 minutes. Up next on the program, we'll get you some morning calls. Plus, we'll catch up with Wamsi Mohan of Bank of America Securities on Apple's upcoming AI rollout. A conversation just around the corner. Those earnings from Apple just around the corner as well. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Counting it down to the cash open, it's about 1 hour and 10 minutes away. Going into it, the scores look like this for the month of August. We're up 0.5%. August getting started in a positive fashion in the bond market. Treasury's a little softer, yields a little bit higher, up 2 basis points against the grain of the previous 5 days. A big rally, 5-day winning streak on a 10-year Treasury. Yields lower by 25 basis points over that period, just about north of 4% on a 10-year this morning at 4.05. That's some of the price action. Let's get you some morning calls. First up, JP Morgan raising its price target on Meta to 610, maintaining an overweight rating. The analyst saying the tech giant continues to earn the right to spend big on AI. Meta's up by 8.6% in early trading. Your second call from Morgan Stanley, lowering its price target on Qualcomm to 207. The analyst citing likely revenue headwinds from the US ban on the company's chip sales to Huawei. We're a little softer there. We're down 0.9%. And finally, Bank of America reiterating its buy rating on Apple. Analyst Wamsi Mohan expecting an earnings beat this afternoon, but says investors will look past the results to the upcoming launch of Apple's AI features. Wamsi joins us now for more with the stock higher by about 1%. Wamsi, great to catch up with you, sir. I want to start with this question right here. If we are to look past the earnings and focus on AI developments, I've got to ask you, when you think we might actually get them, when I can use them and what they'll do and what they look like?
Yeah, good morning, Jonathan. Thanks for having me. Look, I mean, I think that the first catalyst is the launch of the new iPhone, and you need these phones to be able to have the hardware to run the AI feature functionality better. The second thing is that Apple Intelligence is actually in developers' hands at the moment, right? There's developer beta that's been released that has some of these feature functionality. So it's in the works. It's not going to be day one of launch of phone. It's probably going to be mid-October. Some features not going to be available globally simultaneously, so it's going to be a phased rollout. And That just means that consumers have to wait a little longer in certain regions as opposed to other regions to get access to all these features. So in the US here, I think by October, we'll be seeing a bunch of features. But remember, developers are going to be continually adding to the suite of capabilities. And so we'll see more and more of this as time goes on.
I think we'd like you to frame how big this opportunity actually is. I was going through some of the recent research of yours and going back to our previous conversation, the step function improvement that you believe is ahead of us here is similar to the emergence of the smartphone, which is why you and the team have essentially found a new name for it, which is the Intelliphone. I want to build on that a little bit, Wamsi. I've heard repeatedly from Apple bulls that this big upgrade cycle is just around the corner. I want to understand, without mentioning artificial intelligence, how much better these features will be, what they will allow me to do that I can't do currently, that's going to force me to sit here and say, I've got to get a new phone, I've got to upgrade.
Yeah, no, this is a great question. And I think the Intelliphone, as we've been calling it, and thank you for remembering that, is really the fact that you're going to get a step function change in productivity. What does that really mean, right? Like, it really means that a lot of tasks that we kind of manually do by switching across multiple apps, we'll be able to consolidate that into, say, asking Siri to do something very specific. So if you are curious about what the weather is in a particular region, at the same time you're trying to say, well, what are my plans for that day going to be? Those things can be wrapped up together in one request, as opposed to having to go to your weather app and check the weather. You want to check like what your flight times and arrival times are. You want to book your Uber from there. And then you want to plan out your day. And all of those can get wrapped up into one thing, which really enhances productivity by a lot. Now, we're not there yet, right? Like, we're very far from that at the moment. But within the next year, we think that there will be a lot of apps, a lot better Siri integration that can get us there eventually, right? So what is the hardware support that is needed for that? That's improving and increasing, right? Like, we already heard from the likes of TSMC that the die sizes are increasing. That basically means your capability to run more and more like taxing workloads on the phone is going up. And those taxing workloads are really the step function change that we're talking about, and able to take and consolidate a lot of these different requests into one request and then be able to process that. Remember the context of that so that you could go back to that conversation as well. So in terms of the bigger picture of what it means to an upgrade cycle, there are over 1 billion plus iPhones out there. A small shrinkage, just by a few months of the replacement cycle, can mean 10 to 20 million more iPhones being sold, right? So we've been stagnant in the kind of 220, 225 range million iPhones annually being sold. We think that step function changes into 240 to 250 million over the next 2 years. And remember, there's also form factor changes coming, including thinner iPhones, foldable iPhones down the road, maybe 3 years down the road, modem changes. So there's a lot of excitement going on from a hardware perspective to support some of these features.
Appreciate the clarity and the update on that. Wamsi, as always, sir, thanks for your time. Wamsi Mohan there of Bank of America Securities on the latest with Apple. You can look through the earnings later. We've talked about the carrot over the stock for the likes of Tesla. This is the carrot over this stock for the next several years, potentially.
Maybe this particular earnings cycle isn't going to be the revealing one. It might give more of a sense, though, of how Apple is going to win out in this upgrade cycle, because they know that a lot of others are coming for them, including Samsung.
Oh, big time. Big time. I just want a phone that I don't need a cover for anymore. That's a little thinner and smaller.
That's it.
You slips into a jacket nicely.
You don't care if it's a personal assistant as long as it looks nice.
Not really. Just, you know, go back to what it used to be.
Boy.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
60 minutes away from the opening bounce. Some important economic data just seconds away. Mike McKee's in Washington, D.C. He'll break that down for you. The scores going into jobless claims look like this. Futures are positive on the S&P by about 0.5%. On the NASDAQ 100 up by 0.6%. If you switch up the board and get to the bond market, we can take a look at the front end of the curve. The 2-year is at about 427.17. Yields on the session going into the data up by a basis point. With the economic data, let's cross over down to Washington, D.C. and catch up with Mike McKee. Good morning, Mike.
Good morning, John. Well, this is not particularly good news on the jobless claims front, although another warning that July is a little volatile. But 249,000 jobless claims filed last week. That's significantly higher than the week before. The unrevised number from last week was 235. So a big change in initial jobless claims. We also get unit labor costs and non-farm productivity. Productivity rises a lot more than the first quarter and more than expected, 2.3%. Forecast was for 1.8, and unit labor costs drop just up by 0.9%. They were up 4% in the first quarter. So good news on labor costs and productivity on the inflation side of the Fed's mandate, but still some issues on the jobless side, jobless claims side, labor side. Continuing claims, 1,877,000 compared with 1,844,000. So more people getting claims, taking longer to get jobs. Interesting thing I was looking at today is we started today with, John, the Fed funds futures, the overnight index swaps, basically where they were on Tuesday. Volatility yesterday, but everybody expecting at least one rate cut. And now we're pricing in a little bit more than just the one rate cut because these numbers are apparently something that the market thinks will worry the Fed.
I can tell you, Mike, 3 basis point swing at the front end of the curve. Not much, but directionally, this is how we've responded to that data. We're down about 2 basis points now on a 2-year, the very front end of the curve. We were higher going into the number by about 1. So down about 2 or 3 basis points at the front end of the curve becomes a 4 basis point swing at the front end. That's just dancing around the front end. But you can see how we've responded to this. The wrong kind of upside surprise on jobless claims going into payrolls tomorrow. I'll go back to the estimate for payrolls tomorrow. It's 175. The previous number was 206. But certainly, if you get much of a downside surprise on payrolls, maybe an upside surprise on unemployment, Lisa, it just goes back to that conversation that we've had repeatedly on this program. You've got to draw me a line. Tell me what the distinction is between a welcome cooling and an unwelcome deterioration in the labor market.
Yeah, does the Fed still have time to really assess all of the risks and make a move in September of just 25 basis points? I do want to just put into size and scope some of these claims that we're getting. Jobless claims coming in at the highest rate going back to August of last year. Continuing claims coming in at the highest since November 2021. A market shift upward at a time where people are starting to see those cracks in a growing number of places.
Mike, we've had a couple of head fakes so far this year when it's come to jobless claims. They've started to gap out, push higher, and then they've come all the way back in. How much weight would you put on this number this week?
Well, because it's such a big move in a short period of time, I would be reluctant to say it's a new trend. Let's see what happens next week. But we are pretty much past the plant shutdown month of July, so maybe this does have some validity to it. And certainly there have been a lot of concerns about the labor market and how fast it might be slowing. You heard all the questions for Jay Powell yesterday. It'll be very interesting tomorrow to see what happens. And If we got a 0.1% rise in the unemployment rate, triggering the SOM rule, that would be it'd be interesting to see what the markets do with that.
There is this issue going into tomorrow's non-farm payrolls report of what is more important, the headline number or the unemployment rate. We've been talking extensively about that at a time where it's very hard to gauge what the correct amount of jobs being created for this market currently are. Michael, what do you think is going to be more important? Certainly not just for market participants, but also for some policymakers.
Well, I think the unemployment rate is what everybody's going to be looking at first. If we get a really strange headline job creation number, very high or very low, that might take precedence over the unemployment rate. The unemployment rate has been influenced by the size of the labor force a lot in recent months. So we have to look at that first. So both probably, we come into this with both probably being important. We'll just have to see which one dominates.
Hey, Mike, appreciate the update. Thank you, sir. Just to recap things for you. Jobless claims, the wrong kind of upside surprise. Unit labor costs are a little bit softer than expected for the second quarter as well. Let's push this through the market. We'll start with stocks, go to bonds, finish on foreign exchange. Equities stay elevated, up by 0.6% on the S&P 500. In the bond market, we were just a little bit softer at the front end. Yields were just a touch higher going into the number. We're down by about 2 basis points. That's not a big move, but directionally you can see how the market's responded to that economic data. The wrong kind of upside surprise on claims. We just back away a little bit on 2-year yields again, encouraging that idea that maybe this Fed has got to go in September, perhaps even for some of you I know, they think they're late already. Okay, let's turn to foreign exchange. The dollar fades as you get that rally at the front end of the curve. The euro, just a little bit stronger off the back of it, but still down on the session by 0.2%. 108.07. Lisa, that debate gets a little bit more fuel going into payrolls tomorrow morning.
Yeah, especially because this is a point in time and usually it isn't linear. And that's really, I think, what's really creating some anxiety for some people. You know, I'm a little bit confused because we have people come on the show and say that the jobless claims are actually the most high-frequency data and most dependable data to really see and gauge the labor market in real time. And then it comes out and people say it's noisy, you can dismiss it. So I'm trying to figure out which is which at a time where the continuing claims are coming at the highest pace since November 2021.
Over the last 12 months, we have seen claims pop higher and then pull back again. And I think after you've seen a series of head fakes, you do question where we are right now. Let's get to the panel. Greg Peters of PGIM Fixed Income alongside Subhadra Rajappa of SocGen. Subhadra, I want to start with you. You said we see signs of easing, of softening, but no immediate need to ease, to cut interest rates. Where are we in the labour market at the moment?
So we're definitely at a cusp. I mean, today's numbers is something worth paying attention to. We want to figure out if it's something idiosyncratic related to to Beryl in Texas or something else. I mean, but we are hearing other headlines. I heard perhaps Intel is looking to lay off employees. So this is definitely something worth paying attention to. But again, it's very hard to read too much into one data point. Like Mike McKee was saying, you're going to have to look at the totality of the data, and that's when tomorrow's data comes in. It becomes very important. If you look at the headline number, our economists expect another 200,000-ish jobs being created, and the unemployment rate might tick up. But again, the most important data point for me tomorrow is going to be that unemployment rate. If that goes up above, say, 4.2%, that's going to send out alarm bells.
Do you think that this market will respond as if we're already in a recession, if we go to 4.2 and everyone runs around screaming, "Sam roll, Sam roll"?
Not really. I mean, there are many indicators of a recession, and almost every one of those indicators has proven not to be a good predictor of recessions. To me, the one metric that I track very closely is corporate profit margins. And corporate profit margins are still relatively healthy. As Mike McKee again pointed out, it really depends on what's causing that unemployment rate to go up. If it's because there's more people entering the workforce, higher participation rate because of immigration, then that's something that we might want to dismiss.
Greg Peters of PGIM also with us. And Greg, I'm curious from your perspective, what your reaction is to these numbers, given that the balance of risks, or at least the Fed believed, was fairly measured. And the labor market is still somewhat of a mystery, but certainly showing signs of cooling.
Yeah, so I mean, the markets have definitely moved from worries around inflation to worries around labor. At the same time, those worries should manifest quite differently, and they're not. So, for example, if if the bond market's worried about labor rolling over, triggering the SOM rule that leads to a recession, then that should have an impact on risk assets, and you're not seeing it. So for me, there's a continued confusion around the data reads. The bond market continues to price in, I think, too much in terms of rate cuts. You know, obviously, a weakening labor market has a very different output relative to disinflation coming through the system. But risk markets continue to kind of trade happily along. And so I think that disconnect needs to be rectified here over the next couple months or so.
Greg, let's build on that. So who's wrong? Is it the bond market pricing in too much accommodation in a weaker economy, or is it risk assets which are pricing in way too much strength, in your view?
Well, you know, as the answer always is, a little bit of both. But I do think the bond market is pricing in entirely too much Fed accommodation. The way we're looking at the forward curves, there's about 200 basis points of cuts being priced in. I think you need to see a real rollover in the economy for that to come to fruition. And if that is indeed the case, then risk markets are priced too richly. So the disconnect in my mind is more on the bond market side. As you know, Subhadra said, you know, kind of at the micro level, what we're seeing out of companies and boots on the ground, it's still a robust environment.
So, Greg, you had said previously at the start of the summer that the macro story is a positive one for risk-taking. Is that your view still of things as we get deeper into summer?
I think it is. I look at the fixed income markets, the credit markets. I think we're in a very good place. While I do think the bond market's pricing in too much, it has been pricing in too much almost persistently, the past several years. And fundamentals look pretty robust, and less hiring is a very different environment than a lot of layoffs, which is where the SOM rule start to really trigger as that catalyzes the recession. So we haven't seen that yet. We're not really hearing that from companies, and so we think we're in a pretty decent fundamental place here, and the bond market is pricing in too much.
Subhadra, start of the year, consensus trade, bull steepener, 2 years going to rip, Fed's going to cut 5, 6, 7 times, economy's going to decelerate. Didn't see it. July happened. Big rally at the front end of the curve. Everyone gets excited again about the so-called bull steepener. Do you agree with Greg? Do you take the other side of this?
I completely agree with Greg. I mean, our point has been, in fact, for the last few months, we thought the Fed will be on hold for the remainder of the year. So I feel like the bond market is overpricing cuts for this year. And as Greg pointed out, and he tracks this more closely than I do, you're not seeing a rise in defaults in some of these corporations. The corporate sector in general seems to be very healthy. There's money that's going into these risky assets, and financial conditions, broadly speaking, are relatively easy. So this move recently has come from a decline in two-year yields, and at times it's come from rising long-end yields. So if you see real weakness in the economy, you should see the entire yield curve, decline meaningfully across the curve. And a lot of this has been, the unwind of the Trump trade. The market's looking at what the impact of the elections are going to be. So to me, it feels like at least the front end of the bond market is overpriced for cuts given the general health of the economy.
Jason Thomas of Carlyle was on earlier, and Subhadra, you seem to suggest that things are priced to perfection somewhat on an index level, certainly with the momentum trades. And it seems like Greg Peters is somewhat sympathetic with the idea that there needs to be some sort of coming together with some froth coming out of the risk assets and maybe fewer cuts being baked into the bond market. Do you agree that there needs to be sort of a meeting of those worlds, and it means kind of mild losses on both?
Yeah, I think at some point there's going to be a meeting of both those worlds, given the fact that you are seeing some areas of the economy that are slowing down, that are going to perhaps do well, especially the interest rate sensitive sectors of the economy are going to start doing well when the Fed cuts rates. And the question is if they're going to be able to orchestrate a soft landing this time around, or we go to the traditional route where the economy slows down too much and they're too late to the party to cut rates, and that leads to a more meaningful recession. Right now, there's really nothing in the data that suggests that that there's any sort of an urgency for the Fed to cut rates. But at some point, that normalization will happen where the economy will slow down and the Fed will have to cut more deeply.
Greg, just your final thought. Am I characterizing your view correctly, that in some ways there is a bit of a price to perfection kind of feel in markets here?
Absolutely, Lisa. You know, as I mentioned, we're pretty constructive on risk assets. We think the fundamentals are pretty decent for risk taking. The challenge that we have is that it's already priced that way and then some. So the risk reward is really quite poor. So you know, the markets have been front running as they normally do the fundamental picture, but I think it's just priced too much for perfection here. It's hard to be on the right side of the trade from a long perspective.
That was Lisa managing to make even the bulls sound bearish. Greg Peters, a PG, and Sebastian Schaffer, a SocGen. To the both of you, thank you. Well done, Bramo.
Thanks, you're welcome.
Well done. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. The Democratic National Committee says Vice President Harris is the only person qualified for the Democratic presidential ballot. Harris has secured the support of 99% of participating delegates since entering the race less than 2 weeks ago. As for the timeline going forward, the virtual roll call to make Harris the official nominee will run from today until the 5th. Harris is then expected to announce her running mate by August 7th, and then 12 days later, the party holds its convention in Chicago the week of August 19th. And another day, another record for NVIDIA. The chipmaker added $329 billion in value in yesterday's trade. That's the largest gain for any stock in a single day. It's a record the company has set many times over the past few months. But that 13% rally comes a day after a 7% rout, and that wiped out more than $193 billion. In the last month alone, the shares have seen drops that accounted for half of the 8 biggest market cap wipeouts on record, according to data compiled by Bloomberg. And it is day 6 of the Paris Olympics. Simone Biles and some of her teammates are set to compete in the women's gymnastics individual all-round final. In swimming, there are 4 finals on the schedule. All eyes will be on Team USA and Katie Ledecky in the 4x200-meter freestyle relay after she won her 8th gold medal in the 1,500-meter freestyle yesterday. The U.S. is leading in the overall medal count with 31. 6 of them are gold. China, meanwhile, has 11 gold medals and 21 overall. And that's your brief, John.
Danny, thank you. Appreciate it this morning. Up next on the program, we'll set you up for the day ahead and get the latest on the election campaign with Eric Cantor of Moelis & Company. That conversation just around the corner.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Counting you down to the opening bell, just around the corner, 42 minutes away. Your scores look like this in the equity market. On the S&P 500, firmer by around about 0.5% through much of this morning. Moments ago, we had a soft jobless claims print. Upside surprise, the wrong kind of upside surprise. Bonds rallied, yields dropped just a little bit. The 10 years back down to just north of 4% at 4.03. Your trading diary, the calendar looks like this through the next couple of days. At 9:45, we'll get the S&P PMI data. ISM manufacturing gap just 15 minutes later. After the close, we'll hear from Apple and Amazon. We'll round out the week on Friday with the July payrolls report. And as we turn to the presidential election, the DNC set to nominate Kamala Harris in a virtual roll call beginning today ahead of an anticipated vice presidential pick announcement at some point in the next week or so. With us around the table for some thoughts on all of this is Eric Cantor of Moelis & Company, the former House Majority Leader. Eric, it's good to see you, sir. Thanks for dropping by.
John, it's great to be here.
This is not a therapy session, don't worry, but I will ask you about your feelings. How frustrated are you that this whole campaign so far on both sides is just about vibes and feelings and not about policy?
Well, you have to sort of take a step back and realize where we're operating in. We are operating in the ecosystem of the digital universe that we're in, and just the incentives, I think, for much of the press and journalists is to sort of evoke a response that will go viral. And I think that's just where we are right now, and I think ultimately what will happen, the impact of this election will impact families, businesses, sectors, Wall Street, whatever. And I think at the end, we got to get down to this discussion. We're just not there right now.
So you know what would go viral for me? What is antitrust policy? What kind of tariffs are you going to really deal with? And what kind of potential framework are you going to come up with for the federal deficit? Look, there are all these questions that we have that we don't really have answers to, but the hints of it don't point to one party being more business-friendly than the other. Do you get a sense of which that business-friendly governmental party is anymore?
Well, if you take a look at what's going on globally, I mean, we have seen as this year has been dubbed the year of the election, and there have been, I think, almost half the globe's population has gone to the ballot box, so which does speak well for democracy. I know there's a lot of calls for the demise of democracy, et cetera. But I will say that the common theme, in my view, is this sort of populism that has taken on a very nationalistic fervor. And our country is not immune from that either. I look at the left, and they have always been about populism versus business and Main Street. But even my party now, we have seen an increase in the voice, which advocates more of a populist, more robust government involvement in the economy. And I think what that means is we're going to be set up in the Republican Party for a real debate now going forward. We haven't had one of those in a while.
What do you think that debate should be?
Well, I think what it will be is you've got, voices who have come to the fore. I mean, there's been no secret that our vice presidential nominee, J.D. Vance, has taken a very different view than those of us who are more traditionally, let's say, classical, economically liberal in terms of lower taxes, less regulation, a limited government posture and fiscal discipline. Those are the kinds of things that I think someone like me would stand for. And then as far as foreign policy, I don't think that necessarily the voices that are talking about isolationism or nationalism are necessarily those who feel like America needs to lead in the world. I mean, I do think that if it's not for our country, I worry about where the world goes and how that impacts us here at home.
How do you bring that idea back alive in the Republican Party? Because it feels like it's dead and buried.
Well, I do think that we're going to see things play out. I do think we will win the election, and hopefully we'll have a unified Republican government in Washington that can affect some change. And I still think there is the overwhelming majority of members of my party who will serve in policy-making positions who do share some of the, what I call more orthodox Republican positions of lower taxes, creating an environment for investment, for risk-taking, to create more jobs, more productivity, and more wealth.
So is that what you tell your clients who ask, in particular about J.D. Vance and some of his comments, in particular about Lina Khan and the FTC currently and how much it has engaged in policy that he thinks is good in terms of breaking up big business? How do you advise them to understand that if you think that your party, the Republican Party, will ultimately be pro-business?
So it's so interesting because at Moelis, many of our clients are watching what's going on in Washington, wondering what's going to happen on the regulatory environment. There's no question. And if you look at this election, it is an election where we're going to have some change from a statutory standpoint and regulatory standpoint, because there is no incumbent running. So even if the other side, if Kamala Harris were to win, she's not Joe Biden. So let's see what that means. But what I think is going to happen as far as sort of the regulatory outlook is that you'll see change. You'll see a rotation in asset allocations. I mean, we're already seeing so much of that going on in the markets from the S&P into the Russell. But I do think all of this is going to bring about some more activity in the markets. And I know from Moelis & Company's standpoint, we're very optimistic going forward.
Do your clients and your colleagues and yourself donate to both parties to sort of cover your bets, or is it sort of, you know, picking a side?
Listen, look, it sort of goes back as long as I have been sort of attentive to this stuff. You know, Wall Street, business in general, it's not a monolith. It never has been. And it's about trying to affect the policies that create an environment for growth. And if there is an administration like there is now that is very hostile to growth, I see. I mean, if you look at Lena Khan, she has just tried to pursue this very unorthodox sort of thesis in antitrust, and the courts have pretty much pushed her back on that. And I think that there are many in the business community who don't share that view. It's incumbent upon Kamala Harris to step up and say, how is it that she's going to deal differently if she wants the support of the business community?
We'd like to see that interview. I'll put it that way. It's working for her, not having one at the moment and not answering questions. We'd like to see that interview, particularly here at Bloomberg. I want to squeeze this one in. 1 minute. What's the biggest difference between Trump 1.0 and Trump 2.0? How have things changed?
I'm not sure I'm qualified. I think there's only one person who could tell you that, and that's President Trump. But, you know, look, the unpredictability factor is something that's worked for him, so you don't really know. But I don't see any indication to demonstrate that the regulatory environment would be necessarily any different than it was under Trump 1, which was really a deregulatory environment trying to produce more investment and more growth in our economy. And I think, look, Donald Trump is a business person. I mean, he does understand that, you know, Washington can either be an adversary or can be there to provide and condition an environment for investment. And I know that is his goal, to want to win as America. And my bet would be on that.
Well, we all want that. We all want to win. Eric, thank you, sir. It's good to see you. Thanks for dropping by.
Pleasure.
Eric Cantor there of Moelis & Company and former House Majority Leader. Tomorrow, Mohammed Al-Aaron of Queen's College, Cambridge, Sarah House of Wells Fargo, Priya Misra of JP Morgan, Nadia Lovell of UBS. Payrolls Friday just around the corner from New York City. Thank you for choosing Bloomberg TV.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Futures flying after the Fed with 30 minutes to go until the start of cash trading. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, investors cheer as Powell signals that a cut may come in September. Meanwhile, Meta's upbeat earnings also fueling this rally. Now, all eyes turn to Apple and Amazon, which report after the bell today. And from $25 billion to zero. Details on how Bill Ackman's IPO dream imploded in just a few weeks. But let's take a look at where markets are trading about 30 minutes until the cash trade opens. You can see green on the screen once again. S&P 500 futures up about 0.5%. Of course, we had a relatively dovish Powell yesterday. We also had some pretty solid earnings, which we'll get to in just a bit. But you can see that in the NASDAQ 100 as well. That index higher by about 0.5% as big tech roars back to life here, and relatively quiet in the bond market right now, but that's after a big rally, Shonali. You can see we're just about at 4% on the 10-year Treasury yield.
And speaking of rallies, we're watching shares of Meta and NVIDIA both rising pre-market. Meta now up more than 9% after revenue beat expectations, selling that AI story, Katie. Also, Meta in conjunction with NVIDIA on the rise for another day. Gains of nearly 13% yesterday.
Yeah, it's pretty amazing that we had all that concern about CapEx, and still you see Meta really off to the races there. And pretty amazing to see NVIDIA follow through on that huge rally that we saw yesterday. Of course, adding a record amount of market cap. We'll see if that holds. But also a big focus, of course, on the Fed, because there will actually be 2 more CPI prints before that Fed meeting in September, and inflation keeps falling. Paul's Torsten Slok says that the Fed will have no choice but to cut rates.
Growth has actually been quite strong, whereas inflation has been coming down. So we had in the market and even the Fed been expecting that the economy would slow faster for the last 5-6 quarters. That hasn't happened. So that does raise the question, why should the economy be slowing faster over the next 2 quarters if it didn't happen over the last 5-6 quarters? So for the Fed, I do think that if we do get inflation still moving lower, they have now promised us that they will be cutting rates in September.
And of course, you'll remember that Torsten Slok was out with that big call that the Fed wouldn't cut at all in 2024, maybe changing his tone a little bit right now. But for more on the Fed's future, let's get to Michael McKee. He is Bloomberg's Chief International Economics and Policy Correspondent, joining us from Washington. And Mike, you and I have talked about sort of when does the inflation worry shift to worries about growth, and it seems like the Fed is very aware of both parts of its mandate right now.
Yes, and as John Maynard Keynes apparently never said, but gets credit for, when the facts change, I change my mind. And that's what we're seeing a lot on Wall Street and around the world. Bank of England, the latest to move interest rates today. They cut by 1/4 percentage point to 5%. And the question is, do they keep going? Because it was a 5-4 decision, very close. Bank of Japan, as you can see, raised interest rates. The Fed stood pat. But as you can see on that chart there, where they are expected to start cutting aggressively, and the story may be in the labor market. That was what Jay Powell was talking about yesterday and asked about a lot. Do they have concerns about the labor market weakening too fast? And you see it in this morning's jobless claims numbers. 249,000 jobless claims, a big jump from 235 the week before. Now, July is always a month with seasonal issues, so we don't know if it's an actual trend, but as you can see, claims have been moving up for some time. Does it mean a weak payrolls report tomorrow? That's what everybody is going to be watching. The data ahead, as you mentioned, Katie, we get a couple of CPI prints and a PCE print and 2 jobs reports before the Fed next meets. And tomorrow's numbers expected to be 175,000 jobs created and 4.1% unemployment rate. But if we get a 0.1% rise in the unemployment rate, we trigger the SOM rule. If we get to 4.2%, which suggests that once you get to a certain level of unemployment, it accelerates rapidly. So the Fed may be indeed cutting in September, but the question is it because the economy has slowed significantly and we have problems in the labor market, and are they behind the curve, or is it because inflation just went away?
Michael McKee in Washington, thank you for joining us. Of course, come back home. We have jobs to cover tomorrow. But joining us for now is Megan Horniman, CIO at Verdence Capital Advisors. And you see that labor market starting to show those signs of weakness. And you see the earnings picture and some signs of weakness as well in the consumer. Of course, those are backward-looking points. Megan, if you look at the forward look, compared to what you're seeing in the job market, how much more weakness follows through in that consumer story?
I think there's still some weakness to go for the consumer. If you look, they've been spending specifically on credit cards. Credit card debt's at a record high now. This is concerning given the fact that they just continue to spend and fuel this debt level that they have. So I think you're going to see the consumer pull back. We are seeing some weakness there in the labor market. We've seen mixed reports on consumer confidence. There's been some weakness shown there. So I think the consumer has some ways to go here. The other thing is if you look at, I keep mentioning credit card debt, but if you look at delinquencies, they're now rising pretty rapidly. So there's still some room, I think, for the consumer to weaken.
And I want to link together what we're seeing, of course, with the Fed and with earnings season. There was a great story on the terminal today that if you take a look at earnings calls, the words Federal Reserve on track to be mentioned about 380 times on second quarter earnings calls with analysts. That's would be the highest tally ever in records going back to 2001 if this pace holds. And I mean, when you think about that and you think about the health of corporate America right now, the health of the consumer, I mean, how badly do some of these big companies need and want a rate cut?
I think want is the word there of the day. These companies want it, investors want it. This is what I think we're seeing. I think there's a little bit of a difference on the need side of it, though. I do think the economy's slowing. I think the consumer's in trouble, but we're not collapsing. And this, collapse that everyone has expected has not occurred yet. So I think the Fed, that's why they're in this difficult situation, because inflation is slowing. It's not where they want it to be quite yet. The labor market, yes, it's weakening, but the absolute level of unemployment, the 4.1%, is still relatively low. Now, this morning's numbers that we got, and I know it's been mentioned that July has some seasonal effects in it, but when you look at the continuing claims that are at the highest level since 2021, that's something the Fed is going to take notice of as well.
Megan, if you take a look at the 3 cuts being priced in through swaps markets for Fed rate cuts, do you think the economy really needs those cuts right now?
No, not at all. I think if they do anything in September, again, the market's pricing it in fully for September. The Fed's kind of opened that door for that. But they've also made it very clear that there's a lot of information between now and that September meeting. We'll have 2 jobs reports, 2 inflation, more than 2 inflation reports that they'll get before we see that September meeting. So there's a lot of information between now and then. I think the most market-moving event will probably be at the end of this month when we get that Jackson Hole speech. That tends to bring a lot of volatility when the Fed speaks at that symposium. We'll probably get a little bit more idea then if September's a done deal. But I don't think that they have the flexibility, given that inflation, there's many areas of inflation that still are sticky, that they can come in with 3 rate cuts. I just don't see that possible.
Yeah, and it's a good point about Jackson Hole. They always tend to make news in the mountains, so definitely one to watch there. But let's talk a little bit more about earnings season. Of course, this was really the heart of earnings season, one of the busiest weeks out there. You think about what we've learned from big tech in particular. Do you think that this has sort of spelled the end of the rotation trade? Maybe we could still broaden out, but when it comes to leadership in this market, do you think that tech is in the driver's seat?
I think so for now, but I also think that the tech is also being driven by the fact that, as you mentioned, the market's pricing in 3 rate cuts. It's also being driven by the fact that we are sitting at that psychological 4% level on the 10-year, and we tend to see tech do well when interest rates move lower. I think there's a little bit of way too much optimism, I think, almost you could say price for perfection in the tech side. And I think that there is room for rotation in, that we saw in some of those small and mid-cap stocks, but the threat to small and mid-cap stocks right now is how slow the economy gets. If the economy slows much more than anticipated, then you will see, I think, some weakness there because they do tend to be cyclical.
All right, Megan, always great to speak with you. Appreciate you taking the time. That is Megan Horniman of Verdance Capital Advisors. Now let's take another check on futures right now because it looks like we're going to have another rally on our hands. You take a look at the S&P 500, up about 0.4% in the pre-market. Same too if you take a look at the NASDAQ 100, of about 0.3%. Not so great when it comes to the small caps. The Russell 2000 just about flat right now, but let's take a quick peek at some of the big names moving because that's where all the action is. In the single stocks right now, you can see Meta absolutely flying up 9% pre-market, of course, after their performance on the earnings stage last night. Different story for ARM, of course, sticking to that tepid sales forecast, weighing on shares right now, down about 11%. And Carvana actually turning a surprise profit, and you can see that surprise in the shares right now, up about 10%. We're going to get to all of it next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Now to high interest, a look at what's making headlines around the world. Russia is releasing Americans, Wall Street Journal reporter Evan Gershkovich, former U.S. Marine Paul Whelan, and the Russian-British dissident Vladimir Kara-Murza as part of a major prisoner swap with the United States. The 2 Americans have been jailed in Russia on espionage charges denied by them and the U.S., and in exchange, the U.S. and its allies will return prisoners to Russia that they hold under the deal. And the Israeli military said it had confirmed that Hamas military chief was killed in a strike in Gaza last month. The announcement that came after a day that Israel said that it had killed the group's political head in Tehran. And former President Donald Trump openly questions Vice President Kamala Harris's racial identity. Trump spoke at a contentious roundtable at the National Association of Black Journalists yesterday in an effort to reach out to voters of color. Harris condemned the comments, calling out the same old show of divisiveness and disrespect. Katie.
All right, and let's turn back to earnings right now because shares of Meta soaring in the pre-market, up about 9% at the moment. That's after the company reported a revenue beat as investments in AI help it sell more targeted ads. Bloomberg Intelligence senior tech analyst Mandeep Singh joins us now. And this was really the bar that these companies had to meet this earnings season, whether or not they could show that their spending was actually paying off. And in Meta's case, it seems like they actually met that bar.
And look, I think in the case of Meta, they are skewed to e-commerce, gaming, entertainment, these verticals. So it looks like the ad spending is really coming back very sharply for these type of companies. On the AI side, I mean, they are infusing AI across their family of apps. In fact, they called that WhatsApp adoption in the US exceeding 100 million daily active users. I mean, think of the revenue opportunity there, because that's the one app they have not monetized, even though it's got, over 2 billion daily active users.
Does this give Meta more legway here to spend more on AI, ultimately, given the payoff it's seeing across the multiple platforms?
Actually, that's what I was surprised by. They were quite prudent on their call about how they are going about CapEx. Remember, Microsoft said, we are going to increase our CapEx every quarter going forward till the end of 2025. Meta actually underspent versus consensus in this quarter. They said, the lower end of the guide is raised by $2 billion, but they kept the upper end the same. In 2025, yes, they called out they will increase the CapEx, but they seem to be more in the wait-and-see mode as opposed to everyone saying we are GPU constrained and we need to spend more on CapEx.
Well, can we talk about Reality Labs? Of course, that's the division that's building those smart glasses and all their other exciting futuristic stuff. It lost nearly $4.5 billion in the quarter. That is a shocking amount of money. When does that start to narrow, or could it actually expand from here?
Well, one thing they've done, I think, this year is they have shifted some of that Reality Labs losses into AI. So even though it shows up as a loss for the segment, they're actually infusing AI in their Ray-Ban AR glasses. Now, you could argue, is it really AI spend that's showing up in that $4.5 billion loss? Or is it the R&D around the AR, VR? And I think there is a very fine line. You can't really distinguish what is AR, VR versus what is AI. And in this case, I think they have taken the actions to double down on AI, which is paying out. And remember, Meta owns its own large language model. Only 2 other companies have that. That's a big advantage. That's what Amazon doesn't have. That's what Apple doesn't have, and they have to rely on someone else to give them the large language model. So that's a huge plus for Meta.
Benefit to open infrastructure. Mandeep, thank you so very much. That is Mandeep Singh of Bloomberg Intelligence, of course, in the middle of a very busy earnings season. We should also mention ARM, the company reporting earnings yesterday that were strong, but shares are under pressure after leaving its sales forecast unchanged. Don't miss ARM CEO Rene Haas on Bloomberg Technology today at 11 a.m. Eastern. And turning to the big earnings on deck today after the bell, the stakes are high for both Apple and Amazon. Investors are watching for more information on Apple's AI, iPhone, and AWS growth over at Amazon. We're going to discuss this with Maxim Group senior analyst Tom Fort. And you think about the potential over here at Amazon in particular. Curious about what you're more excited about given what you saw out of the rest of the group so far. Is it AWS potential with the cloud, or is it what you might see in advertising?
So what excites me most about Amazon is Andy Jassy's comments last quarter that the company today can both invest for the future and generate profits right now. So when you think about the investor focus for the June quarter, it's return on investment spend for artificial intelligence. And I think it's a very strong statement by Andy that Amazon can have high margin and cash flow today while investing for the future. So I think Amazon's well positioned as far as exploiting artificial intelligence to both drive incremental revenue and to improve its cost structure.
Well, talk to us too also about the investor focus, also specifically on the cloud, on AWS. Of course, we had Microsoft earlier in the week. Feels like a long time ago at this point, but there was disappointment there when it came to Azure growth. I mean, what are you expecting to see out of the Amazon cloud unit in particular?
So I think last quarter, the trend was companies are starting to resume spending on IT and resume spending on cloud. And there had been a lot of efforts on focusing on expenses given the challenging macroeconomic environment. So I'm looking for that trend to continue in the June quarter. I do think that there's some risk to Amazon, as reflected in the Microsoft Azure numbers, that you may not see as robust a performance in its cloud computing division as companies in general are trying to determine if they're getting the proper return on their investment spend on AI. But I think that last quarter's trend on a resume of spending, less efforts on cost cutting by its customers should benefit Amazon in the June quarter.
Tom, you think about the spend that Amazon is making on newer initiatives. You think about the deal they struck with the NBA, for example. How do you expect them to address analysts about these initiatives and how it might pay off in the future?
So I've been doing a fun compare-contrast on Amazon's efforts to disrupt the sports broadcasters, the latest example being this NBA deal, and Temu's efforts to disrupt Amazon, the best example with the fact that they had 3 advertisements during the Super Bowl. So when I think about Amazon's spend for live sports broadcasting, I view it as kind of a lost leader. So to the extent they're disrupting the legacy players, I think that's the advantage for Amazon. But on an individual deal basis, Thursday Night Football for NFL and this potential deal with the NBA, I don't think they're making money as far as incremental Amazon Prime members or even from advertising revenue.
So big focus, of course, on what Amazon is spending money on and, of course, on that cloud. Let's also talk about Apple as well. There's a great story on the terminal today that the headline is Apple, Amazon results are crucial for the NASDAQ 100's next leg. I think a lot of people would agree with that. And you write in your notes, actually, that investor expectations are too high for Apple right now. Walk us through that.
So think about shares trading at north of a 30 times multiple. And what would success look like on an AI-inspired upgrade cycle? Success would be, call it 5 to 10% EPS growth. So you're talking about a PE to growth ratio of 3 to 6 times. So, and by way of comparison, its big tech peers are trading more like 27.5 times forward PE. So I think investor expectations are way too high. If you look at the AI upgrade cycle for Apple, we think it can add 50 billion of incremental revenue, about half the benefit they got from 5G. The reason we think it's half the benefit is there's less pent-up demand. I don't think people waited to buy a next-gen iPhone that has AI capabilities. And then they have regulatory challenges when it comes to rolling out Apple Intelligence in Europe, which is 25% of sales, and China, which is 19% of sales. So I think right now, as it pertains to Apple, the stock's ahead of itself.
To that end, you've seen a lot of upset in some of the big tech earnings we've seen so far. And if you think about any areas of vulnerability, Tom, where are you most concerned?
So I'm absolutely looking forward to their comments on the September quarter and what they're saying about iPhone sales projections. What's particularly interesting, and I think Bloomberg broke the story first, is they're essentially going to ask consumers to buy the new hardware and then wait for a software upgrade to get Apple Intelligence. I can't think of a similar occasion like that for Apple in the past. But I'm going to be paying laser focus on the iPhone commentary for September sales by the company.
All right, Tom, really great to get that preview with you. Really appreciate you taking the time. That is Maxim Group Senior Analyst Tom Forte. And it's interesting, of course, his comments on that AI upgrade cycle. Remember, Steve Eisman, we interviewed him a couple weeks ago. That's one of the big reasons why he's bullish on Apple. Of course, it'll be interesting to see what the company reports after the bell. But coming up on this program, we're going to take a look at the companies making the most social buzz today next. This is Bloomberg.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, this is Bloomberg Open Interest. A quick check on futures. About 6 minutes until the bells ring. You can see still holding on to gains here, slipping a little bit though. The S&P 500 about 0.3%, Nasdaq 100 up about 0.1, and the Russell 2000 now nursing a loss in the pre-market, down about 0.2%. But it's time now for social climbers. The company's making waves on social media this morning. And first up, Moderna reducing its sales outlook for the year thanks to low uptake for its COVID shot in Europe. The pharma giant is trying to maintain its COVID vaccine business while also trying to find new uses for its mRNA technology. Next up, some bitter earnings news for Hershey. The chocolate maker reporting a second quarter miss as consumers spend less on candy and snacks. The company is also facing another batch of challenges, including the rising cost of commodities such as cocoa and butter. And finally, Weight Watchers is laying off employees and cutting costs as it struggles to stay relevant in the era of obesity treatments. Popularity of weight loss drugs from Eli Lilly and Novo Nordisk have really decimated demand for the company's iconic diet plans. Of course, you can follow all the latest company buzz on TRE and Go on your Bloomberg terminal. And Shonali, this is really a recurring theme when it comes to the disruptive impact of those GLP-1s.
It certainly is. And you take a look at what we're seeing across the food industry right now, and you have to wonder, is this because of budgets, Katie, or is this because of those GLP drugs that people are changing their dynamics? You take a look, for example, at Wendy's. For example, they're still seeing the same EPS for this year, but they're cutting their sales guidance as their guest counts drop in the United States. So fewer burgers, but people who are spending money on burgers are spending more on them.
Yeah, I'm looking forward to discussing the impact of all that just in a little bit, of course, on this program. And coming up, actually, we're going to be speaking to iCapital's Anastasia Amoroso on how private credit is filling the lending gap left by retreating banks. That is right up Shonali's alley, and that is next. This is Bloomberg.
biggest risk in property and casualty is that now
climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
All right, we are moments away from the start of the trading session. Of course, this is the first day of trading for August, and of course, it comes after what we saw, all the fireworks yesterday. Of course, you can see we have a little bit of a lift to futures right now in that trade after we got a relatively dovish Jerome Powell yesterday, sort of flinging the door open to a September rate cut. And of course, big tech earnings continue to roll on, and you can see the bells are ringing right now as we take a look, of course, at the NYSE, at the NASDAQ, and let's take a quick check on the major averages, of course, as trading kicks off in these first few seconds. And you can see, of course, the fireworks of yesterday not quite following through today. Of course, the S&P 500 up about just, let's see, 0.3–0.4%. The NASDAQ 100 just about flat, and the Russell 2000 pretty much flat as well. So let's get to the single stock action in the fast food industry in particular, because we have Wendy's and Shake Shack reporting. Wendy's cutting its guidance after a decrease in customers in the U.S. And meanwhile, Shake Shack, it's really soaring right now, or pretty much unchanged. We'll give it a moment. It's hoping to achieve positive free cash flow this year, Shonali.
Also keeping a look on the private asset world here, because two proxy stocks here, Apollo, Blue Owl, both in focus today. Apollo reporting an earnings miss. Profit is dropping at its Athene annuities business. Apollo now down almost 5% after a more than 30% rally this year. Blue Owl down about 1.6% after a nearly 28% rally this year. We're also watching Meta, of course, surging after revenue beat, and ARM slumping as it maintains a tepid annual forecast. Meta now up almost 9%. ARM now down more than 9%. We're going to take a closer look now with Bloomberg's Abigail Doolittle.
And to give great context, Shonali, for those earnings reports, let's take a look at the week in tech so far. And this has everything to do with NVIDIA. NVIDIA, after on Tuesday, slumping to basically a 102 handle from its high, its all-time high on an adjusted basis of 140. Now trying to rebound on the day off of the pre-market highs, up just about 0.5%. Lots of volatility here. And of course, there's a fear that they won't be able to continue to put up the big blowouts that they had, that at some point growth is going to slow. That is, in fact, modeled in. But again, on the week, a nice recovery for NVIDIA, which has been in a bear market, coming out of it now. Now, if we put the Meta and the ARM results into it, well, Meta having a great day, to your point, and they really put up a great, great quarter here. This is taking a look at the AI race overall. Meta putting up that big quarter, so they are in blue there. In white, we have ARM, because, of course, they put up a good quarter. They held the guidance, but investors wanted more given how much the stock was up on the year, at one point up nearly 140%. And then interestingly, there's NVIDIA in yellow. So in yellow, we have NVIDIA. In white, we have ARM. Those are more of the hardware AI makers. And then in blue, Facebook, or Meta, I should say, and purple, Tesla, which are more the shiny applications of AI. At some point, Katie, we're probably going to see it flip, where the hardware becomes more commoditized in years out, and then some of these applications of AI, those uses, they will climb. But right now, this is a look at the race, the AI race, and what it means for these stocks.
All right, Abigail Doolittle, thank you so much. And we should point out that Meta right now rising 10% at the open. That would add $123 billion in market value. So just some incredible numbers that we're seeing right now. Let's discuss all of it with Anastasia Amoroso. She is Chief Investment Strategist over at iCapital. And you think about sort of the mood music heading into this week. It was very tense. And now we have, of course, some of the big names finally out there. Of course, we still have some big ones after the bell today. But do you think we're past peak panic, or at least peak upset?
Well, I think we are for now, assuming Amazon and Apple deliver, but I don't know if we can assume that for both of those. But I do think the results from Meta are really encouraging to the market, because it really tells you that there are ways to monetize artificial intelligence investments right now. And what the markets were really panicked about is, we're spending all this money on AI CapEx, but is the payoff years away or not? And what Meta really shows is that the payoff is actually happening right here, right now. And that is very different from what we saw from other reports where, for example, Microsoft is clearly ramping up CapEx, but the revenue growth expectations are not ramping up as much. So yes, I do think that alleviates some of that concern, but I do agree with that leadership board for now. I think the semiconductors, the hardware stocks, I think their outperformance is likely to continue, because that's what investors are sure about right now, is that the other Max 7 stocks are going to be spending on CapEx.
So what does that look like now that we have a glimmer of hope from Meta? If you think that there's still some dry powder to put to work, do you still put it towards the Mag 7 names, or do you hold off until you see the rest of them catch up to the Meta story?
So now I actually sort of have a three-prong approach. Coming into last week, I would say it's a barbell of defensive stocks and also some of the rotation trades. And the reason we've liked that is because obviously the Fed is on the cusp of cutting interest rates, and I think investors are going to be focused on that. Defensives typically outperform after the rate cut. But the reason why I've now expanded this barbell into this, three-legged stool, and I'm adding semiconductors to things that you want to buy on a pullback. Look, I think within the big tech complex, there's going to be this divergence of who's immediately seeing the benefit of AI, who's not. But again, one thing that we can be sure of is that all of them are going to be spending on AI CapEx. And so semiconductors are the beneficiaries of that. They've pulled back nicely. So that's why I would be adding to that. And of course, it's a cyclical story as well, which will benefit from rate cuts.
So Matt Miller is off right now. He always likes to pull up these complicated terminal functions on screen. I'm going to do that right now, because if you take a look at NVIDIA and then the function SPLC, it shows that NVIDIA gets 19% of its revenue from Microsoft. So that CapEx spend is going directly to another big tech player, NVIDIA, and that's really propping up the whole market. And we spoke to Larry Adam from Raymond James a couple of weeks ago. I wonder how many times I'm going to bring up what he said, but he made the point that you want to go where businesses are spending money, not necessarily where consumers are right now. It seems like, again, you take a look at that very complicated function, that would prove that point.
That's right, absolutely. And if you look at the Microsoft CapEx numbers, I believe they're up something like 78% year over year. So that's a huge number. And so that's why investors are focusing on that certainty. But, the other point I would say, obviously the likes of NVIDIA are going to benefit, but not exclusively. That's not going to be the only player. And some of the headlines we saw this week is that maybe there's some competition that's heating up with other semiconductors as well. So that's why, I would look at buying a basket of semiconductor beneficiaries from AI.
Let's talk about not just what we're seeing out of earnings season, but what we're seeing in the changing expectations coming out of the Federal Reserve. You have a market now pricing in 3 rate cuts this year. Yeah. Do you think that this market needs those 3 rate cuts to materialize to keep the valuations we're at?
Near term, yes. I think so. And of course, Fed Chair Powell did not say anything about the future path of policy. But I think part of the reason why some of these rotation trades have worked as well as they have is because markets are counting on the tangible benefit, the tangible relief from those 3 rate cuts. And if you look at a middle market company or a smaller company that maybe has had leverage that is floating rate, the fact that we have priced in those 3 rate cuts, that's providing immediate relief. Because if you look at the SOFR rates, of which some of those floating rate loans are based off, those SOFR rates 6 months out, they're already coming down. So I do think that if we see some pullback in those rate cuts expectations, the rotation trade maybe gives a little bit of it back. But longer term, I think the Fed and the markets are right to look for something like 150 basis points of rate cuts. And so that's what I'm looking for, and that's what I'm looking through is the actual relief that's likely to come.
And I want to talk about the rotation trade in the context of this very muted IPO market, because someone made the point to me sometime in the past few weeks that you think about the companies that are staying private, it's those smaller companies that might have gone into that small cap index. And now the companies that are going public are debuting as mid cap or large cap companies.
Yeah.
So you're not getting that quality in the small cap index. How do you think about that?
Well, this has been a trend that has been ongoing for probably 20 years. And if you look at sort of before the financial crisis or even further back, the average age of the IPO was about 8 years. Now the average age of the IPO is about 11 years, and that's being extended. And so what happens is when the companies, to your point, do IPO because they've seasoned so much in the private markets, they IPO at much higher valuations. But what this also means is that some of the hyper growth that typically is associated with a company that's an IPO, some of that hyper growth has already happened in private markets. So that's why investors, I think, would be well served to look at both sides of public and private market balance sheet because a lot of the value can actually be created in private markets pre that IPO.
I want to pull up some of the stocks that we're looking at today here too, because Apollo, for example, KKR hit a record high yesterday. Apollo's on the decline today, but their fee-related earnings actually beat expectations. It was their spread-related earnings. So things are getting better for the private markets in some ways. How do investors get a piece of this? If you're a retail investor, you don't have a lot of options here. Is it just buying the stocks of the ones that are publicly traded?
Well, the great news is that you do have many more options than you've had in the past. Of course, you can buy the stocks of some of the alternatives managers that we've discussed, but at the same time, what used to be an institutional asset class and where you needed to have a large ticket size for an individual trade, we are able to bring, as an industry, to bring down that minimum. We're able to expand access. We're able to expand reach to the retail investor. So it is actually increasingly more accessible in some of the traditional drawdown structures, but also semi-liquid structures as well. So I think access is there, but to your point, Shonali, I also really like the market opportunity right now as well. And I think you're absolutely right. Things are picking up for private markets. For example, on the iCapital platform, where we look at the private wealth channel flows into private market assets, we're seeing very strong demand for private credit, which represents about 44% of the flows that we're seeing on the platform. We are also seeing demand for private equity and infrastructure and secondaries. Those are all areas of strength. And when you think about the broader industry, the reason I really think there's a lot of momentum that's building, we are seeing fundraising pick up in year-over-year terms, especially in secondaries, especially in private equity, in direct lending. And we're also likely to see, Katie, to your point, a better exit environment with IPOs and M&A coming to the fore.
Anastasia, we have less than a minute left, but I want to go back to that point about access because it's interesting. If you take a look in the ETF world, and retail investors love ETFs, issuers from BlackRock to Goldman to Invesco are looking at ways to fit private assets into ETFs somehow. When you think about that structure, do you think that's a possibility?
Well, it might be a possibility, but I think a lot of work has to go into it. And I think there's a lot of industry appreciation for you can't just put an illiquid asset in a liquid format and call it a day. There's a lot of considerations that have to be given, and I truly believe that the industry is being thoughtful about that. I mean, to the point of access, of course, a private investor would prefer to have the liquidity, but you have to put really careful guardrails around that if you're dealing with private markets.
$20 says Katie rather see a private equity ETF before a Solana ETF.
There you go.
That is
absolutely.
Asia Amoroso of iCapital. Stick with us. More markets ahead. Busy earnings season. This is Bloomberg.
Trends in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg Open Interest. A quick check on the stock market. Of course, we are seeing green on the screen today, and the S&P 500 rising now at a faster rate, 0.7, nearly 0.8% higher. NASDAQ 100 rising in synchrony. The Russell 2000 getting a bigger bid at 0.3%. Katie.
And it's time now for top calls. Some of the analyst action in focus this morning. And first up, Wells Fargo raising its recommendation on Carvana to overweight, also lifting its price target by nearly $100 after the online used car retailer delivered a surprise profit in the second quarter. Next up, we have Oppenheimer cutting Etsy to a perform rating after the e-commerce platform gave weaker third quarter guidance. The analyst says that the outlook suggests no near-term visibility. And finally, Loop Capital raising Reddit to a buy. Analysts say that there's upside to the street's estimates and cites an attractive valuation. Meanwhile, two stocks we're watching this morning post-earnings are Shake Shack and Wendy's. Shake Shack soaring right now at the open. It announced positive free cash flow for the first time in 7 years. Wendy's stock, it's also rising by not as much. That's after the CFO says that higher-end consumers are visiting more often. Michael Halen of Bloomberg Intelligence joins us now. Let's start with Shake Shack, because in the commercial break, you described the call as awesome. What actually happened?
Yeah, new CEO Rob Lynch has taken the helm. He authored a great turnaround at Papa John's, and it seems like he's got a great plan for Shake Shack, right? It's primarily going to center around improving the marketing program and increasing ad spend. Shake Shack has not done a lot on that end, and he has a great marketing background, so we think he's the right guy for the job. And he's also talking a lot about running better restaurants, improving speed of service, right? Improving throughput. And this isn't rocket science. It's a difficult business to execute in, but it's not hard to figure out. Better food, better service, better marketing should help drive sales in the near and intermediate term for Shake Shack.
When you take a look at what was going on at Shake Shack and when you take a look at what was going on at Wendy's, what does it all tell you, Michael, about what it means to sell a burger in this market?
Yeah, so I would say, from a 5,000-foot view, this is really supports what we've been saying for a while, and it's that, the K-shaped recovery is impacting restaurant sales, right? And restaurants like Wendy's that cater to a higher percentage of low-income consumers, historically in quick service, about 30% of the customers are low-income consumers, right? And those consumers are struggling due to inflation, right? Due to higher restaurant prices and prices, frankly, everywhere, right? And so Wendy's has pretty large exposure to those customers, and they're struggling to drive positive same-store sales. Whereas Shake Shack caters to higher income consumers, and they're seeing less pressure to discount. They're able to continue to pass through larger price increases, right? And that's helping their same-store sales outperform right now.
Well, Michael, to that point, we did hear from the Wendy's CFO saying that higher income consumers are visiting more often. Maybe we aren't exactly seeing that yet in the earnings, but I think that says a lot about just the state of dining out right now in the U.S.
Yeah, from what we're hearing, everybody's trading down, right? From fine dining to lower cost full service, from full service down into fast casual down into QSR, right? It's kind of a cascade effect, right? And so if you're a Wendy's, your low income consumers actually drop out of restaurant visits completely to some degree and shop more at the grocery store. They are attracting some higher income consumers that are saying, maybe I'll eat out at a full service restaurant 1 or 2 fewer times a week, right? And save some money and go to a Wendy's, right? It's such a smaller portion of their customer base that it's not going to offset the traffic loss from the low-income consumers. On the bright side, they do spend more, and they do tend to buy higher margin products.
Michael Halen of Bloomberg Intelligence, we thank you so very much for keeping an eye all over the market for us. Now, coming up next, we're going to talk about Bill Ackman's IPO dreams cut short as he pulls the plug on the closed-end fund IPO. We're going to discuss it in today's Wall Street Beat. Stick with us. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Let's take a check on stocks. About 20 minutes into the first trading day of August, we have a rally on our hands. The S&P 500, the NASDAQ 100 up about 0.6%. Small caps getting in on the action, but to a lesser degree. The Russell 2000 Shanali currently up by about 0.2%.
Matt leaves the kids home alone and the party's on, Katie.
Yeah.
It's time now for today's Wall Street Beat. Bill Ackman pulling the plug on his IPO dream of that closed-end fund after his fundraising targets plummeted in just weeks. Joining us for more is Bloomberg's Bailey Lipschultz, who has been covering this top to bottom. And when I look at the story that was written overnight by Kathy Burton and Annie Massa of Bloomberg, one part stuck out to me, that Seth Klarman was angered that Ackman named him in a letter to big investors about the IPO that was later made public. This letter served as a role in complicating the IPO, didn't it? Is he losing friends over this?
I imagine his inbox is probably pretty filled with messages. I mean, when you look at kind of the pushback that we saw, according to the filing, that letter was never supposed to see the light of day, but he did name drop Seth Klarman's bow post. He did say that they were in for $150 million, name dropping them with Putnam and a teacher's retirement service down in Texas. But it does seem like shortly after that, bow post pulled its commitment, and then obviously things spiraled pretty quickly from there.
Absolutely, and you take a look at the press release that hit the wire yesterday. This question, they say, kept coming up. Would investors be better served waiting to invest in the aftermarket than in the IPO? Because I'm hoping you can translate this. So basically, this is a closed-end fund. Closed-end funds often trade at discounts.
Especially now, and he has an offering already in Europe that trades at a more than 20% discount. So from the start, when I was having conversations with people who actually operate at institutions, who they were really trying to sell this to, in addition to the retail investors, why would you pay an equal amount knowing that it's going to trade at a discount when you also can, though the terms are structured differently, just buy already essentially the same asset?
You're going to get it
for
on
20%.
sale in
Exactly.
like 2 weeks.
So you need to find someone who's willing to put in billions of dollars, and typically closed-end funds cater to retail investors who maybe want to have someone like a Bill Ackman kind of help manage their retirement, and maybe they're not thinking that far in advance, but the institutions are not.
Part of this play, too, was not just the relationship with institutions, but of course his followers on X. Yeah. What does this mean for his relationship to all those followers?
If you think about it, Shonali, 1.3 million followers is a lot for you and me, but it's really a small drop relative to the likes of an Elon Musk or a Donald Trump, who we see rallying millions and millions of followers. And when you do the math and just kind of break down what a $2 billion closed-end fund, which it was targeting at the end, you're still asking for north of about $20,000 a person on X. And a lot of these followers, maybe they are kind of falling for the tweets, or as he kind of framed it, part of his posse. Even if they're putting in $500 million, a lot of these people are seemingly going to line up to give 10,000 plus.
Well, apparently, again, according to the statement, they're reevaluating the structure. They're going to report back once they're ready to launch a revised transaction. I'm sure we'll be checking in with you again, maybe soon. That, of course, is Bloomberg's Bailey Lipschultz. It's time now for the Trading Diary, what you need to be watching this week. Of course, big tech earnings continuing today. Earnings from Apple and Amazon after the bell, plus Intel after the bell later this afternoon. We're going to round out the week tomorrow with earnings from Exxon and Chevron. It's also big oil, in addition to big tech. Of course, also, we get the jobs report at 8:30 a.m. Eastern tomorrow. But coming up in the next hour, of course, on this show, really looking forward to a conversation with TMX Group CEO John McKenzie, of course, the parent of the Toronto Stock Exchange. That's coming up at 10:30 a.m. Eastern in our next hour. Don't go anywhere. This is Bloomberg Open Interest, and this is Bloomberg.
names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast. Economic data coming out, ISM manufacturing coming in weaker than expected. We'll break that down with Tim Fiore, chair for the Institute of Supply Management. It's also a tech-heavy part of the earnings cycle. We had Meta last night, good numbers, stock moving. Apple and Amazon after the close. We'll get all that with Mandeep Singh. He covers Bloomberg Technology for Bloomberg Intelligence. Hillary Spahn, Executive VP at a company called BXP, formerly Boston Properties. Talk about the company, the earnings in the New York real estate market. So a lot coming up in this hour. Let's kick it all off with Mr. John Tucker. We can't get rid of him.
Yes, you can, actually. We're brought to you by Interactive Brokers. Discover the future of trading with their next-generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. We are data dependent. Let's get right to it. This is the smaller part of the economy behind services. ISM manufacturing still important. It is below 50, which is the demarcation line between expansion and contraction, still below 50, 46.8, the latest reading for the month of July. The expectation was for 48.8, so disappointing number there. Also, the prices paid index higher than expected. Stocks adding to yesterday's surge, although at a more muted pace this morning. You have the S&P 500 29 points higher. That's up 0.5%. 55.51 of the index. The Nasdaq Composite Index is up 143 points. That's a rise of 0.8%. The Dow, that has turned lower, 39 points lower. That is down about 0.1%. Just 24 hours ahead of the jobs report earlier, we saw data that's showing Unemployment claims hitting an almost one-year high and worker productivity beating forecasts. Of course, Jerome Powell indicated yesterday officials on course to slash rates in September. A quick look after their earnings report after the close of regular trading yesterday. Shares of Meta Platforms up 10%. And then the worst performing stock right now, the S&P 500, mRNA. That would be Moderna. Those shares down close to 15%. As far as yields, the 2-year yield just turning lower by 5 basis points, 4.20 right now. The 10-year yield just about 5 basis points lower. That's under 4% right now, 3.98. Wow. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. So that breaking data, that does matter. Paul, Alex, hi.
Hi. Happy Thursday. Happy Friday to Paul.
Yes.
Wonderful to see you both. That ISM number, that's ugly.
That got my attention there, yeah.
Also, the jobs number, the employment number in there with 43, that's definitely something. Interesting that we're seeing the buying really coming in, though, to the bond market on that. All right, let's get more into the data because this feels icky. Tim Fiore is chair of the Institute of Supply Management Manufacturing Business Survey Committee, and he joins us now. Okay, we are at an 8-month low, or contracting the most in about 8 months for the ISM manufacturing. You really had that weak employment data. What is leading this? Does this data surprise for you?
Yeah, Alex, so yeah, this is a disappointment. So the last couple of months, we've been stuck, stable, stagnant. We're no longer stuck, stable, or stagnant. We're declining at a faster rate. We're off almost 2 points from last month. We're off almost more than 2 points from expectations. 21 months into a contraction, and we haven't seen a number at the headline level this low since November of 22. So first off, the good news, supplier deliveries are starting to stiffen up. It's a little bit harder for them to deliver. That price index number is a marginal expansion, very weak. Happy to see that, glad to see that. If you're looking for rate activity, that supports a rate reduction, no doubt. On the demand side, we still can't find demand. The demand is non-existent. Backlog is still extremely low. New export orders, very weak, and no real end in sight. Our top 6 industry sectors all showed declines, significant declines, like 45 in the demand side, new orders, and production. But the big story here for the month is really the production number. We've been talking for the last year and a half that, look, as long as the production number stays around 50, revenues or expectations are being met, profitability is probably okay. You just have to deal with the input side. Well, that's no longer the case here. We've fallen down to a 45.9, big drop, disappointing, lowest since May of 2022. And then coupled with that, we've got the employment numbers sagging really strongly. So what it really says, and we've indicated this last month, the month before, is that without new orders, we're going to see a decline in production / revenue, and then we're going to see a decline in employment. And that's exactly what we've seen here. From a sentiment standpoint, you know, I track headline sentiment month to month. We're running at a 1 to 1.4. So there's more people not feeling good about the future than there are people about the future. And you all track the force manage ratio, hire to fire.
Right.
And this is the highest one we've ever had, 1 to 1.8. So there's a lot more companies taking force reduction steps than there are hiring. And so I think we're in for a ride here. Now, you know, the one last thing is we've been looking for a soft landing. That doesn't necessarily mean that manufacturing is going to see a soft landing. We could actually have a moderate landing or even a hard landing, and it doesn't mean that the economy is going to see a hard landing or a moderate landing. So we're in a real strange spot here. I mean, if you're looking for data, facts for the Fed to support a rate cut, don't look any farther.
Don't look any farther than this, right? All right, Tim, thanks for the breakdown. Really appreciate it. Tim Fiore, chair for the Institute for Supply Management on their business survey. Again, numbers coming in weaker than expected for the manufacturing front. Looking at the market's reaction, kind of mixed here. The S&P's up about 0.3%. The Dow's off fractionally, and the Nasdaq's up 0.5%. As Alex was just mentioning, the actions in the Treasury market. Yield on the 10-year Treasury down 5 basis points, 3.97. So we are below 4%. That is notable. Let's get a look at where the action is in the equity markets with
Bailey Lipschultz.
Bailey Lipschultz. Thank you. Sitting right next to me, Bailey Lipschultz. You can talk all you want about stocks. I only have one question for you. Can you explain to me what our good friend Bill Ackerman is doing here?
Nothing now.
Nothing
well,
now.
as of now.
Can you walk us through this story here?
So earlier in the month, well, I guess now we're in August. So in July, he filed to launch and price a closed-end fund that would trade in the U.S. It would be similar, in his words, essentially mirror their European offering, which currently trades under the ticker PSH space NA. Trades at a 20% discount to what the assets that it owns. It's invested in Alphabet, Chipotle, Howard Hughes, Universal Music, a handful of stocks. Beating the drum, he kind of said, we see this as a potential $25 billion offering going to court retail. We're going to court institutions. Basically, I have a lot of very wealthy friends. They're going to give us money. It's going to be awesome. It's only going to be a 2% fee. We won't charge that for a year. Then a couple days later, he wrote a letter to investors in the hedge fund saying, hey, demand's not as strong as we would have expected initially. We're thinking that maybe we'll raise between $2.5 billion and $4 billion. So a sharp drop off from the $25 billion number. He actually name dropped Seth Klarman's bow post. He name dropped Putnam, among others, kind of alluding to people who were already in for the book, saying, get your orders in soon. It's going to help us build this out. Didn't realize that had to be filed publicly. So the next day we see that in a public filing, or at least that's what we're told through the filings. Seth Klarman and Bloomberg has reported, isn't super happy about that. They withdraw their order, they opt out. We see just a few days later, the fund coming back saying, we thought 2.5 to 4 billion. Now we're actually going to go after 2 billion, but don't worry, it's going to price next Monday. So we're still kind of full speed ahead, $2 billion, feeling great. Pershing Square's in for $500 million. Then yesterday we get the filing that because, to kind of oversimplify, because they couldn't answer the question that investors wanted to know, why would I buy this at IPO when I can buy it at a discount? We're actually going to pull the offering, rework it potentially, and try to come back with a different model. So going from 25 billion to potentially 4 billion to 2 billion to now nothing as of now. Though again, he did say they plan on coming back in some potentially different formation.
I don't know what to even ask about that. That was a great explanation, by the way, but it's such a nightmare.
But my angle is, there's an angle here. He's a really smart guy. How do you misjudge the market? How do you misjudge demand? How do you make that mistake of putting out a letter? These are things Bill Ackman doesn't do.
Well, so to start at a high level, the largest closed-end fund in U.S. history was just over $5 billion.
Okay.
So he was coming in with the ambition to 4X that. Because he has 1 million and change followers on X, and he has a strong track record. If you even look at and invested in the European offering, you've done pretty well over the last few years. But to your point, there's so many snags that came out of this. And when I talk to people who operate in the closed-end fund space, they initially were kind of saying, this has to go through a seasoning period. The SEC is going to hold it up, which Pershing Square came out and said was actually playing a factor in the delayed pricing, to the extent that I talked to a couple advisors who said, maybe September, just because you need this to cool off. The way this is structuring, you can't just kind of ignore these warning signs and keep your pedal to the metal. And it does seem like a number of miscalculations have kind of ended up throwing it into a tailspin.
Wow. It's literally like yesterday he was on at the exact same time. We were talking about the different evolution of the story. All right, Bailey, you'll be coming back at the top of the 11 as well. Bailey Lipschultz joining us, Bloomberg senior equities reporter joining us there. Just to recap here, Fed swaps are now fully pricing in 3 interest rate cuts by the end of the year. That comes after that really not great ISM manufacturing data. I mean, when you have Tim Fiore, the guy who puts together the data, saying we might not get a soft landing in manufacturing if the Fed wants direction to cut, this is it.
And it kind of brings me back to the comments that we hear from Danielle DiMartino Booth from QI Intelligence. She's been saying, A, we're in a recession. B, if you look underneath, the data's a lot weaker than the backward-looking data that supports a 2.8% GDP print. Looks like maybe it's coming her way.
Yeah, and that employment read from the ISM manufacturing, really not great. 43 coming in there. Okay, let's go to the individual movers here. One of them is Meta. That stock popping 10%. Did you listen to the earnings call on the beach?
He did. Part of it.
You
but
did.
then a nice swell came in, so I had to drop and go.
I understand. I mean, that's priorities.
Yep.
Mandeep Singh was not at the beach on the earnings call, and I know this because he was on set with me when the numbers came out. Mandeep Singh, Bloomberg Intelligence senior tech industry analyst. You were pretty positive on Meta earnings, and the street really agrees with you. This is AI delivering on helping more targeted ads, meaning more revenue. straight up.
And I mean, look, with all the other AI spend that we are seeing from the cloud vendors, they're saying the revenue will come in 25, 26. Meta is actually delivering AI revenue right now. And that's the big surprise, that all the large language model investments they have done, they have infused their apps with AI, and it's actually yielding tangible returns. And there was a good macro read too. I mean, my sense was e-commerce spending is strong. Gaming spending is strong. That's why there are advertisers who are spending on Meta platforms. So overall, I think macro looks to be much better than what people talk about, and ad spending is strong, and that's why Meta did well.
Is this a read across for Amazon, for Google in terms of the ad spending angle?
Absolutely. I mean, Amazon is skewed towards e-commerce. In fact, anybody who is an e-commerce provider on Amazon's platform has to spend on ads for, slotting. And so I do think, and certain pockets when it comes to ads aren't doing well, which is why Google didn't have that sort of a lift, because they are sort of equal across different sectors, automotive, insurance. Those are the weak sectors. So they're probably not spending as much on ads. But e-commerce, retail, these are the pockets where the ad spending is strong. And I think Snap should do well tonight.
So the CapEx spend also, so they narrowed the range specifically to come in for 37 to 40 billion rather than 35 to 40 billion. They didn't raise it, which is not what some of the peers have done. Was that also a positive for the stock?
Absolutely. I mean, they've learned their lesson. Last time around, they raised the CapEx by 3 billion. The stock reacted negatively. This was more a wait-and-see approach. They did say 2025 CapEx will go up like every other hyperscaler. But for this quarter, they actually came out below consensus, $1 billion below consensus when it comes to CapEx for this quarter. And like you said, they reaffirmed the guide. And overall, I feel like everyone keeps talking about how they are GPU constrained and they need to spend more CapEx. Meta didn't say that they are GPU constrained in any way. At the same time, they expect AI infrastructure spend to go out, and they're able to monetize it. WhatsApp, to me, was the real bright spot. I mean, nobody has been able...
Are they monetizing that yet?
Actually, yes. So they did give a data point yesterday where family of apps, other revenue grew 73%. Most of it is WhatsApp. So WhatsApp actually is a $400 million run rate business now.
Really? Okay.
Yeah.
It's only taken 10 years.
And that's where I think they called out the U.S. adoption. So WhatsApp now has 100 million active users in the US, and that's where they see AI infusing in WhatsApp being a revenue generator.
All right. Market likes it. Stock's up 9% today, up 47% year to date. All good in Meta land. Tonight after the close, Amazon and Apple. Let's start with Amazon. What are you going to be looking for there?
I mean, cloud, AWS growth, ads growth. I think that one thing that stands out between Google, Microsoft, and Meta versus Amazon and Apple is Amazon and Apple don't have their own large language model. One thing we realize with Meta is because they own their large language model, they've been able to deploy it so quickly. Well, Amazon is relying on Anthropic to give them the large language model. Apple announced Apple Intelligence, but they're delaying it. They don't have their own large language model. And what everyone is realizing is owning a large language model like Microsoft OpenAI, Google Gemini, that's a big advantage. And that advantage may continue, I think, given everyone is so bullish on generative AI.
So how is that going to wind up showing up in the numbers?
So, I mean, look at Meta's ad pricing. The reason why ad pricing grew so much is because they actually applied the large language model on their own products. Same thing with Microsoft. The reason why their Microsoft's cloud revenue has accelerated is because the workloads are getting deployed, the co-pilots are getting deployed in their own products. So Amazon has to somehow, leverage the large language model, Anthropic or somebody else's. In fact, Meta said they are warming up to Amazon more and more to deploy their Llama large language model on AWS. That'll be an interesting partnership if that pans out, because Meta doesn't have a cloud-facing business, whereas Amazon AWS is the largest cloud provider. If they can leverage Llama model, which Meta owns, that could be a huge driver of revenue for both Amazon as well as paying a licensing fee to Meta. But obviously, nobody called that out, so that's a speculation at this point.
Fascinating. All right, really good stuff. Can't wait.
It's not just selling ads anymore. It's all this other stuff.
It's not all other stuff. Well, it is about selling ads, but in a more efficient way. All right, I took my notes for those coming out after the closing bell. Mandeep Singh, Bloomberg Intelligence, Senior Technology Analyst. There we go. I got it. All right, coming up, we're going to talk about commercial real estate here. Hillary Spion is Executive Vice President of BXP. We're going to really drill down into New York commercial real estate after BXP delivered earnings. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The initial boost to stocks this morning looks like it's starting to fade at this point. Major averages, they've turned mixed. Economic data sending yields lower. Manufacturing activity shrinking in July, but the most in 8 months. The more policy-reactive 2-year yield is 6 basis points lower, 4.19 right now. The 10-year has dipped below 4%, 5 basis points lower. Right now, we are at 3.97. And just 24 hours ahead of the jobs report, data earlier this morning showing unemployment claims hitting an almost one-year high, worker productivity. That beat forecasts. Jerome Powell indicated yesterday officials on course to slash rates in September. And right now, Meta Platforms, among the most actively traded, one of the best performing stocks in the S&P 500 after their earnings report right now, 8.4% higher. Slimming down the Weight Watch, WW International, better known as Weight Watchers, laying off employees, cutting costs. Well, it's not funny. Blockbuster obesity drugs decimating the business at WW International. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
Those GLPs really work. So it's a big deal. So if you're Weight
Do we
Watchers,
know somebody who's taking them?
We do.
Oh, okay.
And it works significantly and quickly. So good stuff. John Tucker, thank you so much. We appreciate it. Bloomberg Intelligence, Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So that means video too. So go to youtube.com and search Bloomberg Podcast, and that's where you'll find us. One of the stories that Alex and I like to continue to focus on is commercial real estate. It's undergone a tremendous change over the last 4, 5, 6 years, obviously with the pandemic, and longer-term trends here that still need to be understood and worked out. So we like to talk to smart people to get a little bit smarter on this. Hillary Spahn joins us. She's Executive Vice President at BXP. BXP is a publicly traded real estate investment trust. BXP is the ticker handily. Market cap $11.2 billion. Stocks pretty much unchanged today, up about 2% year to date. Hillary, thanks so much for joining us in our studio. New York City, let's focus on New York City. That's your remit here. Yeah. A lot of empty space here in New York City in the offices. Mm-hmm. Tell us where we are and how we're going to get out of this, if at all. Explain to us how the commercial real estate environment is in New York City today.
Sure. Well, first of all, Alex and Paul, thank you for having me this morning. I think that it's fair to say that the market is bifurcating itself, and that means that there are groups of properties that are performing quite well, actually, and others that are performing less well. Those properties that are newly constructed, that have been reinvested in by their ownership, and that are well located are generally doing pretty well. And as evidence of that, if you look at the vacancy rate in the Park Avenue submarket of Manhattan, it's less than 10%, which is quite tight by historical standards. You're seeing landlords there with the ability to push rental rates, to reduce concessions like free rent, like capital that's associated with new leasing. And so therefore, net effective rents are actually increasing in that submarket. In some of the weaker submarkets and some of the older buildings, landlords have had more trouble attracting tenants. But for those businesses that are generating revenue, that have clients that need to come visit them, that want to attract talent, being in a great building in Manhattan is a really good bet for them. And you're seeing strength in that segment of the market.
So we've had some property people in here who've talked about those older buildings, and over the last few years, they spent a lot of money retrofitting them and updating them to make them more appealing. Are we seeing a lot of that still? And what's the cost profile for that? Is it pay off? How does that work?
So I think it's also a little bit location dependent. You're certainly seeing some buildings spend money that would be classified as older or maybe less well amenitized, just not a newer building. But if they're in a great location, they can actually do quite well. And I would point to the Grand Central submarket as evidence of that. A lot of people who commute in the city are really looking for a one-seat commute, meaning they get off of Metro North or they get off of Long Island Railroad, they walk to their office. And so those buildings, despite the fact that they're somewhat older in that submarket, are leasing quite well. And a lot of the landlords that own in that district are amenitizing their buildings to great effect. The cost of construction have gone up radically over the last, call it 5 years, and that does definitely have an effect. It tends to favor the landlords that are better capitalized. But for those that can do it, it really does benefit their leasing velocity.
How about, I'm going to reference this once again. I always do when having commercial real estate discussions in New York. Bloomberg News put out a piece maybe 18 months ago, and just focusing on 3rd Avenue between Grand Central and here. We're at 58, 59th Street. You can't give that stuff away. Or talk to us about that market. I'm thinking like the Lipstick Building. When I see one of those buildings trade, is it going to be at a 30% discount, 40, 50, 60% discount? Talk to us about that kind of market, because those are more, I guess, B properties as I understand it.
Well, so there actually has been some activity on 3rd Avenue. Memorial Sloan Kettering, I believe, took some space in the Lipstick Building.
Okay.
One of the office buildings that is on 3rd Avenue was recently announced to be a conversion to residential. So folks are getting creative with that space. For us, in our submarkets, we're focused on attracting large corporate tenants and investing the capital that's required to attract and retain them. But I think that 3rd Avenue has hope.
So let's just game this out for a second. So swaps market's pricing in 3 Fed rate cuts now for September, right? I mean, excuse me, for the rest of the year, starting in September. Let's say that happens. What's the trickle down to the commercial real estate market in the short term?
So the transaction volume, acquisitions, dispositions has been somewhat muted. Not so much as a result of where treasuries are trading, I think, but how quickly they went from practically zero to where they are today. Any relief on the 10-year, I think, would tend to support higher transaction volumes. In our space, which is, again, the sort of higher end of the market, there's been very, very little transactions because, in general, landlords are not distressed and are not willing to sell at depressed prices. So I think it would tend to support a higher transaction volume going forward.
You guys, BXP, well-capitalized, well-experienced owner of real estate. Are you buying in New York City today?
At the moment, we don't have active acquisitions, but we're constantly looking for new opportunities. The real gating issue for us is quality. So if we cannot find something that is at least equal to the quality of what we already own, we are not buyers. And the fact of the matter is there's relatively little available in the market for purchase that is consistent with our quality. That having been said, we do have a couple of development sites in New York City, the most active of which will be 343 Madison this year. It is it's between 44th and 45th on Madison, and it will we will begin constructing the east side access to the Long Island Railroad in Grand Central between now and the end of the year. So folks will actually see cranes and construction on the site.
So I live in Brooklyn. What about in Brooklyn? All the cool kids. No, but they're like retrofitted, like that sugar factory. Not you guys, but sugar factory is retrofitted. Like they're
Domino.
There we go, Domino's. Well, is Brooklyn becoming a place where commercial real estate can truly thrive?
So I would say that the demand for Brooklyn right now is a local demand. People that need to be in Brooklyn for a reason. Their manufacturers are located there. Their talent base is located there. Those tend to be the companies that are expanding in Brooklyn. We own a building called Dock 72 in the Brooklyn Navy Yard, and we've had success in that building with leasing to Huge, which is a marketing company that was formerly based in Dumbo, has moved to the Navy Yard. The Pratt Institute and other large sort of Brooklyn-based institutions. I would say that Dock 72 has attracted the majority of the large tenants that are active in the Brooklyn market now, but no question, it's sort of a local demand market at the moment.
You guys own the General Motors building, one of the most iconic buildings in the city. Tell us about that building.
So the building is 96.5% leased. Wow. We recently had a client expand by 100,000 square feet in the building, taking up most of the availability in the building. We recently spent a lot of time and effort amenitizing the second floor of the building with wellness, with food and beverage options, and with conferencing, which I think is increasingly important to clients today. And it's really borne itself out in the leasing that we've been able to achieve there. So the building is basically full.
So when we say wellness, what does that mean?
We have a 17,000 square foot gym that has personal training. It has physical therapy. It has massage available. It has locker rooms that are like a spa.
Yeah,
it's great.
I'm in. You said massage. I didn't hear the rest.
Anytime you want to stop by,
so,
let me know.
There we go. What would you guys like not? What doesn't make sense right now? Like if people, clearly sellers are going to want to be out there selling their property. It's obviously the price is going to be a problem. What have you been pitched to that you're like, no way, why would anyone think that's a good idea? Or is it just a price situation?
No, for us, again, I think it gets back to quality. There are certain assets that we would not want to own just because we don't think that they can be made into a premier workplace, which is where we're focused. That's our segment of the market. And so our gating issue is it already premier or can it be made to be premier through reinvestment? And those are the assets that we're interested in, nothing else.
Are your clients, where are they in terms of back to work? Are we now at the new normal, whether it's 3 days a week or Bloomberg's 4 days a week, for example? Are we at a new normal? Is that what your clients are telling you?
So in our space, again, our buildings tend to have people who are revenue generators for their companies occupying the space. They have been back to work, and it's really not so much a topic of conversation in our office at all anymore. Okay. We are at or above physical occupancy that existed pre-pandemic today. Now, it's off a little bit on Fridays and Mondays, but in the middle of the week, we actually are right back where we were before the pandemic.
You guys also own the 599 Lexington, that beautiful building. Yeah, it has like a tower. It's like,
well, that's 601, I think.
Oh, 601. That's 601.
Yeah.
You own
and
that one
599
too,
is
right?
right across the street. Yeah.
Yeah. How are those doing?
They're great. So 601 Lex has 9,000 square feet available. It's a 2 million square foot building, plus or minus. And 599 Lex is where our offices are, actually, and that building is very well leased as well. We do have a little bit of space coming available in that building, and there is a lot of demand for it. People are calling us and saying, we want it, and can we have it now?
But, right here, Lexington, 58th and 59th, all these stores are empty. Except the chocolate store, because everybody needs chocolate.
Yeah.
What's going on in your buildings? Do you have that ground floor retail? Is that a component of your buildings?
We do. We have lots of retail in our buildings. We built out a food hall in 601 Lex. We also have street level retail. Look, we think of our retail as complementary to the office experience. And for our clients that have office space with us, we want to make sure that they have a great experience going out and grabbing something healthy and fresh and convenient for lunch. And so we've really looked at our retail as a way to complement our premier workplace and not just as a revenue generator in and of itself. And we've been able to attract really, really great options. So I think, our approach has been very successful, but it's very much done with our clients in mind.
Really great stuff. Really interesting. Thank you so much for coming in. Come back. Keep us updated. We love touching on this topic. It's also important.
Can I point out an architectural oddity along Park Avenue for
You sound like my
office
husband,
buildings?
but yes.
No, it's true, because the lobbies are all raised, kind of, if you go down there. And that's because I suppose the lack of elevator wells, because underneath the buildings, you can't go down. There are railroad tracks.
You are exactly
Look
right.
at John Tucker bringing out some
How
New York
did you
City
know that?
knowledge.
No, I'm just...
Did you research that while we were there? Was this what you did for the last
What,
10
just
minutes?
now?
Yeah.
No.
He saw a YouTube video on it. That's where he gets all his knowledge.
That's
But think about it.
And he was
Walk down
trying to
Park
construct
Avenue,
his
all
own
the lobbies
table
are
saw.
on.
But you're exactly correct. That's why.
Okay.
Thank you very much.
Thank you, John Tucker.
I did not
the
know. I lived in
brilliant
the city all my life.
More
Hillary
business
Spahn,
knowledge.
thank you very much for joining us. Hillary Spahn, Executive Vice President in BXP, joining us live here in our interactive broker studio. Talking about commercial real estate. Again, I guess the story I'm learning is if you've got good properties, you're in good shape. If you have something less than good, then perhaps still a struggle out there. We're going to have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. And with this Bloomberg Business Flash, we have the major averages. They are all lower right now. The data in the driver's seat for the most part. Manufacturing activity shrinking in July by the most in 8 months. That news sent yields lower. Earlier, we saw unemployment claims that hit an almost one-year high. Worker productivity beat forecasts. That raises the odds of a September Fed rate cut. Also seems to be worry about a slowing economy. Major stock averages, again, after yesterday's rally, lower. Only 6 of the 11 major index groups in the S&P 500 are up right now. Communication services in the lead there, and that is where you're going to find Meta. Shares up 7.7%, but pairing some of the earlier gains after their earnings results and after the close of trading today. Of course, we will hear from Apple and Amazon, so keep it right here for all the details. Just crossing the Bloomberg, Glencore's billionaire ex-head of oil charged with corruption. And Paul, as with anything energy related, I always turn to the experts, like Alex.
Oh, I thank you. The same way that I look at construction and think of John Tucker. This is according to the Financial Times. And, Glencore isn't alone in this. A lot of the other trading houses have had issues with corruption in the past. But this is the UK Serious Fraud Office charging Alex Beard and 4 other former executives with making corrupt payments after a long-running investigation into these allegations. And this concerns trades in Africa as well. Now, Beard was head of that oil division from 2007 to 2019, and he is the highest profile commodity trader to be charged with corruption at this moment in the UK. They opened an investigation back in 2019. There were allegations of bribery connected to its West Africa desk, which sourced and traded crude all across the continent. So definitely keeping our eye on that. That stock is off by over 2% over in the UK. One stock that is up, wait, were you done?
Oh, yeah.
Oh, okay, great. I don't want to take it away from you.
Oh, no.
You don't want to do that.
I actually wish you would more often.
Never, John Tucker. One stock that we are watching to the upside, though, is Eli Lilly. That stock up about 2.5%. Its blockbuster Zepbound has now improved the long-term health of patients with obesity-related heart failure, illuminating the cardiovascular benefits of the weight loss shot. Obviously, that's going to be really important for Medicare and other insurance companies to then cover these drugs. Well, joining us now is Michael Shaw, Senior Pharma Biotech Analyst for Bloomberg Intelligence, joins us now. Is there anything these GLP-1 drugs can't do?
Yeah, I know. They seem to be, hitting all their endpoints in all these different indications. But yeah, absolutely. Another positive data set here for tirzepatide, another win for the GLP-1 class in general.
So
I mean, sorry.
No, go ahead, Mikey.
Oh yeah, no, I was just going to discuss the data and perhaps what does it mean for for the drug and for the space in general. I mean, I think this was a trial basically that tested Zepbound or tirzepatide in obesity-related heart failure in patients with or without diabetes. So it was called the Summit trial. And it basically showed, a reduction in the risk of the heart failure outcomes, and then we also saw improvement in heart failure symptoms and physical limitations as well. So I think, the result was largely expected. We've seen positive data for, Lilly's main rival in the space, which is Novo's Wegovy. So that, that's awaiting an AdCom for approval in HFpEF already, so preserved protection on heart failure. But all in all, when we think about, the overlap between obesity and heart failure and, all the comorbidities associated with it, we think, the data is essentially going to, expand the label, and then it should also, expand reimbursement and access as well for the drug.
Hey, Mikey, give us an update on kind of just the reimbursement scenario out there. Is it country by country? Because I know here in the U.S., some people's insurance covers it, some people's insurance doesn't cover it. Where are we in the evolution there?
I mean, we're definitely seeing improvements in reimbursement. I think that's going to, accelerate as and when we get kind of more and more data points in these comorbidities, and we'll also start to see the price of these medications drop as competition comes in. So, the cost of these therapies is a bit of a sticking point at the moment for insurers. We're still kind of running tight on supply, so that's kind of held back some of the launches outside the US. But I think in general, all these data sets that we're seeing, be it in sleep apnea and heart failure, they all speak to they all essentially promote these GLP-1s and kind of support the use of these GLP-1 drugs early in treatment.
I have a really silly question for that, though. In order for the GLP-1s to help things like heart failure, does the person have to be obese and have heart failure? Because you can have heart failure and not be obese.
Yeah, so I mean, most of these trials at the moment are in kind of obesity-related heart failure. I'm sure we'll see, trials for primary prevention as well going forward. But at the moment, the label support the trial supports expansion into an obesity into obesity-related heart failure.
Mikey, where are these companies in developing oral GLP-1s? Just taking a pill, a lot easier than getting a shot, I guess.
Sure. So, I mean, there's quite a few companies, developing orals. We'll probably see the first, around the 2027 timeframe. So in terms of, who's developing them, Novo, Lilly, Structure. We've also seen some early data for Vikings. At the moment, Lilly's orforglipron, that's really in the lead. But at the end of the day, I think what's going to happen is, efficacy is one thing, but, the ability to scale these drugs to treat, to address this demand is going to be key. So a lot of focus is going to be on the kind of molecule size, how easy these drugs are to manufacture as well going forward.
Do we know if insurance companies, and I guess this is really just a U.S. question at this point, are going to be covering these drugs and Medicare, I guess, more specifically?
As in the orals?
Either. I mean, that's the thing, right? Like, these guys have to prove that it helps other stuff just than obesity.
Sure. I mean, I think the long-term benefits, we've seen the cardiovascular outcomes data for Wegovy already. So these drugs have proven long-term benefits. So it's kind of tossing or weighing up the the long-term cost savings with the the initial kind of investment in and providing access to these drugs. In terms of the cost point, you'd expect that to come down with with oral molecules or oral small molecules or oral GLP-1, sorry. And then we also should see kind of better adherence as well with these oral molecules. So that could lead to longer-term benefits as well.
All right, Mikey Shaw, thanks so much for joining us. Mikey Shaw is Senior Pharma Biotech Analyst at Bloomberg Intelligence, which just begs the question, what does Sam Fazeli do all day? I mean, he's got all these great healthcare analysts over there in London.
Yeah, he's got to do his wine stuff.
He's got to do his wine
that's
stuff.
That's a full-time gig.
I'm looking at this story. Walmart workers' Zoom outburst shows angst over relocation plan. The retailer's employees have a tough choice of reporting to Bentonville, Arkansas, or coastal hubs, or finding another job, because they're one of those companies that were pretty liberal in terms of the work from home. And now they're saying, okay, back to the office, and that means Bentonville. Or on some of their other coastal hubs here. But if you've relocated to some, Park City, Utah, I'm not sure you necessarily want to go back. But that's kind of goes to our earlier conversation here in New York with, talking about the commercial real estate, that people are back certainly Tuesday, Wednesday, Thursday, but maybe Monday and Friday a little bit different.
Yeah, and Paul understands this because he doesn't come to the office on Fridays in the summer.
In summertime, that's just not.
That's his thing.
Not in
but it also, although to be fair, he works like every other holiday. But and this is also some other big like office migrations. And you make this great point when it comes to Boeing when they moved. I mean, this is 20 plus years ago.
Yep.
But they moved from Chicago to Chicago from Seattle.
Yep.
And that was like a big cultural shift also within the company.
Yeah, all the engineers, all the manufacturing stayed in Seattle, but the senior execs, the C-suite kind of moved to Chicago. And again, my personal opinion, just based on conversations with people I know that are in the engineering side in Seattle, they kind of felt like that was the company walking away from its roots of being really engineering driven as opposed to profit driven. And that's kind of been arguably one of the contributors to some of those problems they've had over the last several years. So keep an eye on that. Get back to work in Bentonville, Arkansas. I've never been, but I'm sure that'd be a cool place to visit. This is Bloomberg.
company news headlines on Bloomberg Radio.
And I'm John Tucker in the Bloomberg Newsroom. Look at some of the company stories we are following for you. Fascinating Bloomberg article. Each year in April, the government conducts a lottery that shapes the lives of hundreds of thousands of people and even the economy. A drawing for a limited number of skilled worker visas known as the H-1Bs. Tech giants, startups, banks, drug makers, they all vie for slots, hoping to snap up international graduates of top U.S. universities who must otherwise leave the country. Most don't get picked. Some of the lucky winners went to work directly for companies that you know, Amazon, Intel, or J.P. Morgan. Others went to a very different kind of firm. The game, it turns out, is rigged. There's new federal data obtained by Bloomberg revealing how thousands of companies got an unfair advantage by helping themselves to extra lottery tickets for the visas. Walt Disney planning a fresh round of job cuts in its TV division, as all part of an effort to reduce costs in a shrinking part of the business there. The company eliminating about 140 jobs. That represents 2% of the staff at Disney Entertainment Television. And the cuts will fall hardest on the networks like Nat Geo and Freeform. They're scaling back their programming, as well as the company's ABC stations. CarShield, you've seen their commercials, maybe even got their emails. They're going to pay $10 million to settle charges from the FTC that the company made false claims and inaccurately stated celebrity endorsers were customers in their ads. Celebrities in CarShield's TV commercials include the rapper and actor Ice-T. CarShield markets and sells vehicle service contracts offering extended warranties. And that's a look at your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday. Happy Friday to Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. We are broadcasting to you live from the Interactive Broker Studio right here in Midtown Manhattan. We also keep you up to date on all the geopolitics that are emerging from the world, because I keep getting note after note, being an oil nerd myself, about the heightened geopolitical risks right now within the Middle East, particularly if Iran gets dragged in even more than it already is into the conflict within Israel and Lebanon and Gaza. Joining us now from Israel is Ethan Broner. He's Bloomberg Israel Bureau Chief. Ethan, can you just walk us through the chain of events over the last few days and where things are right now?
Sure. So on Saturday, late afternoon, a missile came into the Golan Heights from Lebanon and killed 12 kids who were playing soccer. Israel accused Hezbollah of doing it, and they had pretty good evidence that that's who did it. I don't think it was on purpose that they killed the kids. I think they were aiming for a military site but missed. So Israel, the following day, went in and killed a top Hezbollah commander, a guy called Fuad Shukr. And then, 7 hours later, a bomb went off in a guest house in Tehran, where Ismail Haniyeh, a top Hamas leader, was sleeping. He had spent the previous day at the inauguration of the new Iranian president. So everyone said it was Israel that did it. Israel typically is quiet about what it does in Iran, but I think there's little doubt that it was Israel. And so right now we have Iran, Hezbollah, the Houthis, and Hamas all saying that they're going to take revenge on Israel. And I think there will be something. I think the Iranians have said that they crossed a red line and so on. So today there are funeral processions in Beirut and Tehran and speeches from religious leaders and lots of threats coming out. And the American officials are running around trying to get everyone to stay calm. I think it's certain that there will be some kind of a retribution, some kind of an attack that's Iranian-sponsored or led in the coming days on Israel.
Ethan, the last several days does not appear like either side is moving towards a ceasefire, which had been talked about in recent weeks. How did the last few days impact that?
Right. It's very likely that those talks will freeze for a while. There's an unconfirmed report that Hamas is backing away from it entirely now. But you know, this is not uncommon in this region. It's a pretty brutal region. Even historically, when Israel was negotiating with the Palestinians for peace and fighting terror, they would say we fight terror as if there's no peace talks, and we talk at peace as if there's no terror. So, I mean, this is not uncommon for these parallel things going on. A lot of people think that the reason that Hamas would do a deal is because they need a deal, not because they love peace any more than anyone else in this region. So it will delay it, and it could blow it up. But there is a line of thinking that it won't necessarily set it off course for very long.
And quickly, Ethan, before we let you go, I was reading that the leader that was killed in Iran is also a negotiator for Hamas. Who's going to take up that helm now?
So, I mean, there are plenty of people that can take up the place. And to be honest, Ismail Haniyeh, while he was a political leader and a negotiator, he was essentially carrying errands from Yahya Sinwar, who is the main Hamas guy hiding in tunnels under Gaza. So I don't think that's a major problem, except for the sense of humiliation of having this guy killed in that way.
All right, Ethan, thank you so much for joining us. Really appreciate your reporting. Ethan Bronner, Bloomberg Israel Bureau Chief in Tel Aviv. Again, a flurry of activity over the last several days, seemingly just putting some of those ceasefire talks perhaps on the back burner here, at least in the short term. WTI crude oil off about 0.9% here, $77.20. A little bit of that risk premium coming out of the market that we saw in there yesterday. We'll keep an eye on all of that. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to focus in on technology. We had strong numbers out of Meta last night, stock trading up. After the close today, Apple and Amazon, a couple other leaders as well. Dan Ives, Managing Director and Senior Equity Analyst at Woodbridge Securities, is going to join us to break it all down for us. Greg Friedman's going to join us as well. He's at Peachtree Group, I'm guessing that's Atlanta, Managing Principal and CEO on a state of commercial real estate. And Abigail Doolittle, who follows the markets for us, she's going to join us as well, so that should be fun. And it's Thursday. That means we check in with B. Ritholtz, Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters of Business. We'll get his thoughts on these markets. But right now, let's kick this hour off with Charlie Pellet.
All right, I thank you very much, Paul Sweeney. Right to the numbers here. Fast-moving markets to the downside. In fact, we are at the worst level of the session right now after initial gains. We have got the S&P 500 index now slumping by 37 points, down 0.7%. The Dow dropping 394 points, down by 1%, and NASDAQ now lower by 183 points, down 0.9%. The 10-year below 4%, 3.96% on the 10-year. The 2-year 4.18%. Gold up 0.1%, 24.49 the ounce, while West Texas Intermediate crude 77.13 a barrel. WTI now down by 1%. Bond traders now fully pricing in 3 Fed rate cuts this year. The world's biggest bond market rallied after weak economic data this morning spurred concern that the Fed will have to be aggressive with rate cuts to prevent a bigger slowdown. Earnings from Apple and Amazon will be critical to give direction to the NASDAQ 100 after a volatile period. As for markets and the Fed, Jack Caffrey is equity portfolio manager at JP Morgan Investment Management.
You have a Fed that shifts from being data dependent to, I think, looking to, we've done it. It's hard for them to declare victory because their forecasting record has been uncheckered by success in the past, but one where I think that things are lining up to be more positive than not.
Jan Caffrey of JP Morgan. Again, the 10-year, 3.96%. The 2-year yield right now, 4.18%. Earnings, Meta Platforms are now higher by 6.7% after last night's report. And of course, the big events coming up after the close of trading today. We'll hear from Apple, Amazon, and Intel. Apple down 0.8%. Amazon up 0.3%. Intel lower by 2.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much. I'm Alex Steele alongside Paul Sweeney. Welcome to Bloomberg Intelligence Radio. We keep you up to date on all the major news you need to know through our lens of our Bloomberg Intelligence folks. They cover pretty much everything worldwide, about 130 industries and 2,000 companies. So even one stock that's off its high, Paul, is Meta, just up 6% now versus the nice surge that we saw. So it feels like maybe bad news now is actually bad news. The ISM just sort of that tipping point into the stock sell-off as well as a run into the bond market. Bailey Lipschultz is a Bloomberg News senior equities reporter, and he joins us now. What's your take on the desk right now?
Well, the NASDAQ 100 now down 1%. It does seem, to your point, bad news is now bad news. What does this mean for the Fed? Obviously, we are expecting a Fed cut in September, but now do you risk the Fed moving too slowly? And that was really kind of the concern coming into really yesterday's meeting. Again, it was expected that they wouldn't cut. Jay Powell basically said you can more or less pencil in September, but if we keep getting data that are deteriorating, the question is where are people going to put money to work? NASDAQ 100 down 1%. The equal weighted index for the S&P trades under SPW has been under pressure, also down 1%. We're seeing small caps now down, so it does seem like maybe that flight back to the likes of a Meta beating expectations, but it does seem like jitters are actually kind of back for this time.
Yeah, we had Professor Cam Harvey on from the Fuqua School of Business at Duke, and he was just adamant, as he's been for a while now, that the Fed is just way behind. They were way behind, curbing inflation, and they're way behind now in terms of cutting rates, and he really called them on the carpet. So, what else are you seeing out there, Bailey, in terms of the market, other than Mr. Ackman can't get his IPO done, which I
Still love
fascinating. Can't come back. I can't help but come back to. No, we're keeping an eye on.
It's been an hour, so things could literally have changed.
Based on how the last 2 weeks were.
I think we can get 100 million done. That's good.
Yeah.
No, sadly, no update from Mr. Ackman, but still seems, that closed-end fund again a few weeks ago was penciled in for $25 billion potentially, then scaled back to $2 billion, is off the table. Still waiting to see when that could come back to market. Talking to people again, keeping a close eye on September, just given kind of the timing of IPOs, being able to meet with investors and what that could look like.
Quick question on this one. I mean, Bill Ackman's cred and his success rate is what could be helpful to him, but he's also become much more outspoken in terms of politics. Does that hurt him? Or is it hard to say with this?
I think it's hard to say because people will quickly point to what he posts on X and shares on X. And the counterpoint is Tesla's doing quite well and Elon Musk is one of the richest human beings in the world. And he tweets very outlandish things. So it's an interesting divide. The real thing comes back to fundamentally closed-end funds, A, trade under their net asset value. So the argument that they couldn't answer was, why would I buy this at IPO when I can buy it at a discount a week, a month, a year later? And B, primarily cater to retail investors. So maybe retail retirees want to trust a BlackRock, but trying to say, hey, you should invest in a U.S.-listed fund that you can essentially get at a 20% discount overseas is kind of a head-scratcher.
ARM Holdings, what's happening?
Under pressure, down 16%. They beat on the quarter, but did not raise their guidance for the full year. The big question comes back to, as you see potentially a pull forward in demand, as you see potentially weakening economic kind of currents, I guess, if you will, broadly speaking, for the second half of this year, for the full year of 2025, it does seem like there's a little bit of uncertainty on what they can bring in. This is a company that designs chips. They make a lot of their money off of royalties and licensing agreements. So if demand for chips kind of falls short, that hits their top and bottom line.
And there was a great sort of recap on what we learned from Qualcomm and ARM Holdings when it comes to, say, phones. So people are still buying high-end fancy phones, but we're not seeing a super cycle. and that's just eventually just trickling
Wait
and
till
hurting
September
Qualcomm
when I
and
go
ARM.
out there.
Yeah, but you buy the high-end phone, right?
I think.
So you will. But then to do the super cycle, that's a different story, and that's where we're not truly seeing the recovery yet, and that's going to be weighing on these kind of chip makers.
And I think a big thing to just keep in mind in general with ARM, the stock is up about 140% from a September IPO. SoftBank owns 88% of it. So even when you look at, okay, well, a certain chunk's bought up by the Qs because it's in the NASDAQ 100, how that trades impacts it, it's still a very tight float. It's almost should be treated until SoftBank changes their strategy as a low float IPO. They can have massive swings to the up and downside. And that's something we've tracked, again, for the almost 1 year that it's been traded.
All right, Bailey, thanks so much for joining us. Really appreciate it. Bailey Lipschultz covers all the markets for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. A busy earnings cycle here for the tech names. We had Meta last night, some good numbers. That stock trading up. And big afternoon today after the close. Apple and Amazon report. Let's check in with one of our go-to tech folks, Dan Ives, Managing Director and Senior Equity Analyst at Wedbush Security. He's not in our studio, and he's not even Zoom, so we can't even see what
his
outlandish outfits.
He's probably wearing like a black suit at this point, and we can't see it. It's upsetting.
Exactly. Dan, thanks so much for joining us here. Let's start with Apple here. I kind of feel like they need some more explaining to do in terms of, you know, some of their strategies here in terms of the market in China. What are you going to be looking for from Apple?
I mean, it's really about the China growth. We think it's the last negative quarter for China, and then that starts to now have a tailwind going into the AI-driven super cycle. And I think this is the beginning of what's going to be a historic period for Apple, and I think broader tech, as this week's validated the AI revolution is real, and now the consumer piece comes through Apple.
So this is still going to be a show me story, though, Dan, because all the indications we've gotten from China, from any sector, is not good.
Well, our checks in terms of units, which originally for iPhone 16 was, let's call it 84 million, which is now up to 90. So the point is, like, for iPhone 16, that continues to ratchet up, but it speaks to our point. The haters hate Apple at 160, despise it at 200, and will absolutely hate it at 250. So as we're going into this phase, it will be prove me, but betting against Apple and Cupertino has been the wrong move.
So talk to us about the services side of the business, Dan, because for a long time, a lot of bulls were saying you got to focus on services because that's the high margin business and it takes you away from the replacement cycle risk and all that. Is services still a key story for the Apple stock?
Oh, I mean, Paul, you've talked about this a lot. I mean, services is key to the valuation of Apple. It's been big to the sum of the parts story. And actually, I'd say it's the biggest way that maybe people have missed Apple is not recognizing that this essentially was a re-rating story led by services the last 2 years.
Mm-hmm. So when it comes to their indications on their own Apple intelligence, Mandeep Singh from Bloomberg Intelligence was pointing out that, Apple doesn't have its large language model. So what do you think what are the questions that you and other analysts are going to have on the call about LLM?
The big focus is really developers. Developers now will start the process of building hundreds of apps on the Apple ecosystem. So I think Cook talking about what initial feedback is from developers, maybe giving some breadcrumbs into iPhone 16, that's going to be the important thing. But if you take a step back, 270 million have not upgraded their phones, Paul could be included, in the last 4 years.
Boom.
And I think now you go into what should be is an AI-driven super cycle.
So from your perspective, Dan, has Tim Cook and Apple, have they allayed the concerns of investors or some investors that Apple's really not going to be a prime beneficiary of AI? Have they allayed those concerns, do you think?
Oh, I think they have. I mean, look, goes back to WWDC. Stock was 190, right?
Yep.
Everyone thought it's over. They didn't show it. Look at it today. And the point is, because I think now the street recognizes that the AI revolution on the consumer side goes to Apple Park. On the enterprise side, it's godfather of AI, Jensen, NVIDIA, as well as Nadella. But on consumer, it's Apple.
Yeah, it's such a good point. And I think you made that point with us on our show a few weeks ago, and that was a good distinction, right? Which kind of brings us then to Amazon, because Amazon has the consumery side when it comes to just e-commerce, and then it obviously has the cloud, and then that AI side. What are you expecting after the bell? That stock is flat now on a pretty heavy tape.
Big focus is AWS. Look at the cloud strength we saw from Alphabet, despite the knee-jerk rise continue to be a head scratcher. Look at the Microsoft cloud number. I think Amazon's going to be strong on AWS, and that's important for them to show, don't forget about us when it comes to the AI revolution. That's what Jassy is really going to be focused on in the call.
So give us a sense, Dan, about how investors should position Amazon Web Services in the context of the AI play. How do they fit in really?
Yeah, it's a great question. I view it as if Apple could show, and I believe they can, that they can monetize that leadership position in cloud and actually monetize from an AI perspective, very similar to what Microsoft's doing to Google. That then all of a sudden from some of the parts could add significant value to some of the parts of the Amazon story. So that's really what they need to focus on. Consumer is what it is. I mean, advertising and margins, you could kind of, some focus there, but it's really about cloud and proving that they will be an AI beneficiary.
How did we see that in the line items when it comes across?
It's really around AWS strength. We expect upside. And then on the call, walking through not just Anthropic, but like the overall AI strategy and what they're starting to see in their customer base. You triangulate that with Alphabet, Microsoft, AMD, it's 9 p.m. in the AI party, goes to 4 a.m.
There we go. There's the headline for you. What about CapEx for Amazon?
I want to see them continue to accelerate it. To me, it's an arms race that's going on. So as much as you could fret about some of maybe the CapEx, that's what you want to see from Meta. You want to see Microsoft. You want to see from Amazon. Now, investors will be like, okay, where's the payback? Rome wasn't built in a day. This is going to take 6, 9, 12, 18 months. But at the end of it, fourth industrial revolution, Amazon wants to be a huge part of that. And that's what investors want to see, even though bad is good, good is bad.
Microsoft, just, one segment on that, Dan. How's the Microsoft story shaping up for you? I know you've always been very supportive of the stock. Where are they right now?
It was a validation moment. I mean, the reason tech went green yesterday and all the white knuckle fields were late, it was because of Nadella talking about the acceleration in Azure and talking about AI monetization is now here. Because there's two people that everyone in the world's focused on what they say on AI. Godfather of AI, Jensen, Nadella. And what you heard from Nadella, that the Rubik's Cube that you're trying to figure out, that was bullish in terms of AI validation, combined with what Lisa Su talked about from AMD, very bullish.
So before I let you go, Dan, we're looking at a day where stocks are selling off. We definitely had bad news when it came to the ISM manufacturing data at the top of the 10 o'clock hour. How much leg do you think this maybe next move of the tech sell-off can have?
I think this rotation from big tech to small cap, we think is very short-lived. Fed's next move to cut in that cycle with big tech earnings that we're seeing. I'm not saying that you're not going to have some speed bumps here, but we believe we are still in the early stages of this tech bull market, and that's how we've handheld investors through some of the roller coaster.
All right, Dan, thanks so much for joining us. Dan Ives, he's a managing director, senior equity analyst at Wedbush Securities, giving us his thoughts on big tech. Again, after the close today, Amazon and Apple. I'll be paying attention from the beach.
Yeah, I think it's going to be really fun. I was really surprised about Meta. I mean, I was really skeptical going in terms of they don't have the same kind of cloud plus AI to deliver, but that ad impressions and in terms of the quality of the ads was really quite impressive. So I was surprised that stock holding up despite the sell-off in the equity market.
Yeah, so I mean, I think for Meta and for Google as well, anybody who's selling advertising, what AI does is allows you to better target your audience, which is important for advertisers because they don't want to waste their advertising dollars. They want to make sure every advertising dollar is going to someone who they really want to reach. And that's one of the advantages of digital advertising overall versus, say, buying a TV ad or buying an ad in the newspaper, something like that. You're getting everybody, people you don't want as well. Digital does a better targeting. AI just makes it even better.
Yeah, so and it has a premium? Does digital have a premium to TV?
Oh, yeah.
Oh, okay.
Yeah.
All right. But
So
it always has, hasn't it? In the last 10 years or so?
Yeah, I mean, it's interesting. They target different advertisers, but the CPI the cost per point is really interesting. So it's just a premium. They're taking share across the board. NASDAQ, I'm looking at here. It's we're at the lows of the day, down about 1% on the NASDAQ 100. So we will keep an eye on that. Yields coming in as well. 10-year Treasury 3.98%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index, and the Russell 2000 deeply in the red right now. A turnaround from the early going right to the numbers with the S&P now down 38 points, a drop now of 0.7%. Stocks getting hit as bonds rallied after weak economic data. The Dow now down 477 points, down 1.2%. NASDAQ now lower by 172 points, down 1%. The NASDAQ 100 index down 1.1%. The Russell 2000 index of small cap shares hard hit, down 2.7%. 10-year below 4%, 3.99% right now, with a 2-year yielding 4.20%. Spot gold just about flat on the day, down 23 cents, 24.47 the ounce. And West Texas Intermediate crude down 1%, 77.15 a barrel. Intel, Amazon, Apple all reporting after the close of trading. As for what to expect out of Apple, Dan Ives is with Wedbush Securities, and he was interviewed moments ago right here on Bloomberg Intelligence.
I mean, it's really about the China growth. We think it's the last negative quarter for China, and then that starts to now have a tailwind going into the AI-driven super cycle.
Dan Ives of Wedbush. Analysts expect Apple to report revenue of $84.5 billion in the quarter. Again, Apple shares down 0.8%. Meta after earnings up 6.3%. Recapping stocks lower, S&P down 0.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on this internet thing. I'm not sure what it is, but head over to the YouTube thing, and you'll find us there. Let's continue our conversation on commercial real estate. We heard from someone earlier today, a guest who really is focusing on the New York market. In New York, if you've got A-listed properties, you're fine. If you got B and C, not so fine here. But let's broaden it out a little bit. We can do that with Greg Friedman, Managing Principal and CEO of Peachtree Group. I'm just guessing it's Atlanta. He joined us live here in our Bloomberg Interactive Broker Studio. Abigail Doolittle joins us as well. We appreciate that. Abigail Doolittle, markets reporter for Bloomberg News. Greg, thanks so much for joining us here. Talk to us about Peachtree. How do you guys play the commercial real estate business? Equity, debt, regional, where do you guys go?
Yeah, so we invest across the U.S., so it's just domestic, but we invest up and down the capital stack. So we invest on the credit side as well as the equity side of commercial real estate. So we're a little bit unique in the sense that we do, as part of our, company, we have different verticals that go out and actually lend to commercial real estate. We buy a lot of debt from financial institutions and banks and regional banks. We also buy and develop real estate. We buy and develop primarily hotel assets that are, select service, limited service type hotel properties on the equity side, but the credit side, we're diversified.
All right, I'm trying to get a sense, and I think a lot of people are trying to get a sense, is how bad is a commercial real estate out there, and where are we going to see it? Where are we going to feel it? Where are we in the kind of this 9 innings of trying to normalize this market when people's behavior has really changed, whether it's working or traveling and that kind of stuff? How do you guys think about that?
Yeah, I think commercial real estate's very bifurcated today. If you have like a long-term fixed rate loan, you bought an asset several years ago, you feel really good about where you sit in life, assuming that loan's not maturing here, in the near term. If you have loan maturity issues, if you're, if you're dealing with, loans that are floating rate that are unhedged, you're dealing with a lot of that balance sheet stress. You hear a lot of the headlines talk about the stress that's going on in office, which is really just that secular distress. You take office out of the equation, real estate with loans that are maturing are under heavy pressure right now because these rates are resetting, in most cases, double or even triple what they were paying, from the previous loan.
Well, let's talk more about that, because by the end of 2025, let's call it more than 1 trillion to 1.5 trillion CMBS coming due. Because you are on the credit side, you're really seeing the plumbing a little bit more closely. It's interesting. There's this debate among some of the commercial real estate people that we speak to, and some are a little bit more optimistic, saying it's just office, and then there's others. And Josh Zegan is coming to mind, strictly on the credit side, very close to the banks, saying it's much, much more negative than people think. Where do you stand on that? Do you think it's a much more difficult position than, say, some of the Blackstone activity might suggest?
Personally, I think it is. I think it's a lot more negative. There's a lot of negative leverage. So if you're buying assets today, in a lot of cases, you're having negative leverage because rates are so much higher than where a lot of these assets are trading on a cap rate basis, even though cap rates have moved up. And not to mention, if you bought an asset pre-2022, especially during the pandemic, cap rates had compressed down to this like unsustainable level where a lot of assets, if it was like a multifamily asset, industrial, were trading in this 3 to 4% range, in some cases a little bit higher. But rental growth rates haven't really allowed for those cap rates to grow enough to sustain interest rates that are, again, in most cases, you're in the, mid-single digits at a minimum, if not higher single digits. And that's what's causing a big challenge across commercial real estate.
All right, so I'm sitting on a piece of real estate down in Peachtree Street, Southwest in Atlanta, the worst city in the country for naming streets, by the way.
Right.
I mean, it's like by a bunch of second graders. I'm sitting on a piece of property. My mortgage is coming up. I got to refinance it at twice or maybe three. What do I do?
Yeah,
What
so I mean,
happens
there's definitely debt out there today. The reality is regional banks, community banks, the national banks make up 50% of the commercial real estate lending market. They're not lending at the same level that they once were. Groups like us, on the credit side, we're doing lending today. We've done about $1 billion of loans this year so far. So we're actually, providing loans to groups that need to recapitalize or refinance as loans are maturing. In a lot of cases, though, using that example, they're going to have to come in with additional liquidity. So they're going to have to do potentially a cash in. Exactly. They're going to have to come in with capital to allow for that refinance to occur, that equity.
So speaking to the other side of your credit business, you also buy, and during the pandemic, you were one of the biggest buyers of loans. I would imagine there's a lot of bargains out there today. Are you super active?
Yeah, so I mean, we bought over 180 loans during the pandemic, so we were super active, as you mentioned. Today, we bought, this year, we bought close to about a dozen loans since the end of last year to, today. So we haven't bought as much paper as I would expect.
Where are you buying that on the dollar? Although I know some folks say that's not a good way to look at it, but like in terms of what kind of bargain are you getting?
Yeah, so what we found
in what assets?
Yeah, so it's not huge discounts, because what we're finding is, unlike during like the great financial crisis, because we bought a bunch of loans then, we got huge discounts. And, back then, banks had done higher leverage lending, going into this cycle and even into the pandemic, leverage levels were much more, I would say, conservative by most, banks and financial institutions. So the discounts weren't as large, but we're finding that the banks that are trading paper, they're usually selling off their better paper, which means that it's loans where the asset value is greater than the loan balance. And so the discounts just aren't as large given that factor. So
how hard is it to come to agree on pricing?
It's very challenging because
is it easier or harder now than 8 months ago or something?
It's still
really
hard. Yeah, it's still very hard. I think that's going to change towards the end of this year because part of the challenge, the losses that different banks need to take, they don't have the reserves to take them, and they're not willing to take those losses today. I think that's going to change as their loan loss reserves are increasing over the next couple of quarters, and I wouldn't be surprised if you saw a lot of regional banks sell off a lot of paper in the fourth quarter this year.
Do you think the commercial real estate business, I don't know, pick however you want to answer this, has it found its bottom yet, or are we still searching for a bottom in valuation?
Yeah, so I think a lot of people believe we found a bottom. I question it just because we don't have a very active transaction market. It's very muted on the transaction side. I do think we're probably closer to the bottom, although I wouldn't be surprised, depending on where rates settle over the next 6 to 12 months, that will be a big indicator. When I say rates, really the 10-year Treasury rate. I mean, the 10-year Treasury rates come down, below 4% today, but that's still double where we were pre-2022 when you look, over that decade where we averaged closer to 2%. So that's putting a lot of pressure on the underlying values of these assets, and that, potentially means values could potentially reset higher if the 10 years truly stays above 4%.
So in terms of that bottom, no matter who you talk to, whether they think that things have already bottomed out or if they're going to bottom out in 6 months or 12 months, one thing that everybody involved in commercial real estate seems to agree that this is going to take a long, long, long time to work out. Do you agree? And if you do, how long is it? Are we looking at a couple of years just scuttling along the bottom of, and why is everything so logjammed? When does it break up?
Yeah, so I'm a big believer that we're going to have it's been sluggish over the last couple of years. So starting, going back to the end of the first quarter of 2022 till now for commercial real estate, it's been a very sluggish period. And I think we're going to continue to have that, unfortunately, that sluggish period for commercial real estate over the next several years. And it's just going to take time as these loans are maturing, asset values continue to sort of, recalibrate, or really ownership groups have to recalibrate to where the new interest cost is. Mm-hmm. So it's just going to take time to get through this slug.
Well, that's what I'm really interested in, because let's just say we get 75 basis points of cuts this year, sure, right, as swaps market are now pricing in. How immediately does that affect what you see?
Yeah, I personally, I think it doesn't really move the needle that much. I mean, I think it helps a little bit, but it doesn't really, it's not as impactful as you'd think. I mean, it obviously brings down debt service costs, floating rate debt, by, call it 15%, which is helpful, if it went down 75 bips, roughly about 15%. But your interest costs, if you think about it pre-2022, you're still up, call it 17x. Mm-hmm. because I mean, you were next to zero, right? Like what people are paying off of SOFR, and now all of a sudden, you move down 75 bips. It's not going to be, probably as helpful.
So going a little bit more macro, I know that about 30% of your portfolio on the equity side, hotels, mid-scale, mid-level hotels, you own, I think, 90 of them or so, although some of that might be credit. Sean Hare of Trinity Investments joined us last week and also joined Alex and Paul, and he was saying for luxury hotels right now the growth is 8%, but for lower level hotels it's down 2%. Are you seeing this, and what does it say about the consumer? Because we continue to see this bifurcation on the consumer between the high end and the low end. Are you seeing that relative to your hotels?
Yeah, I think without question, I think consumers that are on the lower end side obviously are impacted by inflation, higher debt expense. The luxury segment hasn't been as impacted, and that's because that consumer has held up much better this time around. I do believe when you look at our portfolio, we're in the mid segment, and so we have a lot of select service hotels that are like Marriott, Hilton branded assets, and those hotels are continuing to have positive RevPAR growth. So we're up about 3% year to date, but you're definitely seeing occupancy slow down. RevPAR is.
I know. Okay. Revenue
Right.
per available room.
That's right.
I was going to
You
show
got
off
it.
to Alex and Abigail. Just real quickly, if you were to go buy a piece of commercial real estate, an office park in suburban Atlanta, what kind of discount do you think you'd get off of the pre-pandemic valuation?
It really depends on the asset.
Because it's
but you're
only
getting-
70% out. I've seen this property 1,000 times in 1,000 towns. It's 70% occupied. It's parking lots half empty, all that kind of stuff.
I mean, if it's going to trade, you're getting like 50% discounts.
Wow.
Is my just high level number without going through the nuances, and potentially you're even seeing larger discounts for some of these assets to trade. I mean, there's one big asset in Buckhead, Atlanta right now that's coming to market. Or at least the debt's coming out to market. And it's going to trade at a pretty substantial discount to where it was pre-pandemic.
And Buckhead's still Buckhead.
Buckhead's still Buckhead. Yeah. It's just shows you the
The
challenges
Ritz-Carlton
in
in
the office
Buckhead. They loved me back
They
in the
loved
day.
you back then?
Yeah.
Now, not so much. This is a really fun conversation. Thank you both so much. Greg Friedman, Peachtree Group Managing Principal and CEO, Abigail Doolittle, Bloomberg News Markets reporter, who also has her real estate beat as well. Coming up, we're going to talk to Barry Ritholtz, because it's Thursday, and that's what we do. Barry Ritholtz is founder of Ritholtz Wealth Management and host of Masters in Business. Just taking a look at what we're seeing right now in the markets. Also, Germany is now sending back convicted killer to Vladimir Putin in this prisoner swap. We are definitely staying on top of this story. This is Bloomberg Intelligence. Happy Thursday.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Another leg lower for the U.S. stock market. In fact, we are at the lows once again of the morning. Stocks getting hit, bonds rallying after weak economic data spurred concerns that the Fed is waiting too long to start cutting rates. 10-year now below 4%. Right now we have got the 10-year yielding 3.99% with a 2-year 4.19%. The Dow slumping 523 points at 40,322. The Dow down by 1.3%. S&P 500 index down 55, a drop right now of 1%. NASDAQ down 257, a decline of 1.5%. And the Russell 2000 now lower by 3%. Again, the 10-year under 4%, 3.99%. Spot gold down $1.90 the ounce to $24.45, while West Texas Intermediate crude down 0.8%, $77.30 for a barrel of WTI. Jobless claims now at the highest in almost a year, adding to evidence that America's labor market is losing momentum. And with that story, here's Bloomberg's Vinny Del Giudice.
Jobless claims rose by 14,000 last week to 249,000, above last year's average. The total number of workers on unemployment is also up, rising to the highest since 2021 after running at historic lows. Interest rates at 2-decade highs are weighing on American businesses, and Federal Reserve Chair Jerome Powell now sees risks to the labor market. On Friday, the government issues the July payroll report, and economists anticipate slower growth. Vinny Del Giudice, Bloomberg Radio.
Meta Platforms, parent of Facebook and Instagram, holding on to a gain of 5.6% after earnings. After the bell today, we've got Apple now trading lower by 1%. Amazon also will report down 0.9%. We'll also hear from Intel, lower now by 3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. You're listening to Bloomberg Intelligence Radio. We want to get you updated on some of that breaking news that we just received in relation to the prisoner swap. As we know, Russia freed Wall Street Journal reporter Evan Gershkovich, as well as jailed Kremlin critics in the largest prisoner exchange with the West in decades. And this is in return for a prized assassin who was sought by Russian President Vladimir Putin. The swap, which took place on the airport tarmac in Ankara, Turkey, included 24 people, 16 going to the West and 8 being returned to Russia. We had just gotten word that among them going to Russia was Vadim Kareskov, who was serving a life sentence in Germany for the 2019 killing of a Chechen separatist in a Berlin park. Those are some of the details as we know them. Now, President Biden is expected to address this at 12 p.m. in the state dining room at the White House. All right, getting back to these markets, as Charlie Pellet was just talking about, we are trading quite heavy. The NASDAQ almost down now by 2%. We're over to 1.5% at this point, just sort of really accelerating to the downside here. Barry Ritholtz is founder of Ritholtz Wealth Management and host of Masters in Business, and he joins us now because it's Thursday. Hey, Barry, what do you make of this dramatic sell-off here? Like, is this sort of step 2 of the tech trade unwind?
Yeah, this is really fascinating. You know, you just can't make some people happy. We heard for a couple of years, oh, well, this terrible concentration in tech. It's awful. It tells you that there's no broad participation and, you know, it's a one-trick pony. And then, you know, that was an unbelievable July. We did a quick analysis going back to 1985. Looking for any calendar month where the NASDAQ underperformed the Russell 2000, 11.8% in a single month is the biggest performance gap going back 40 years. It's really amazing. And it's telling us markets are broadening out, more stocks are participating. I don't know how else to say it other than that's healthy.
How about the volatility in this market here? I mean, the VIX is, you know, about below 18, so nothing going on here. But we've seen some movement here. Is this a market that still needs, I don't know, a 5 to 10% pullback for no other reason than for its long-term health?
I mean, we typically see a 10% pullback about every 12 to 18 months. When you look at July and the uptick in volatility in July, I have to remind people the S&P gained 1.2% despite the volatility. And that very much tells me, what is that, like 14.5% on an annualized basis? That's a pretty typical normal month. You know, in between 15 and 20% is about where you want to see the VIX go. But by the way, the only two negative sectors in July were technology and communication services. The other 9 sectors were all positive. Again, that broadening out, that more participation, as opposed to the way bull markets tend to end, increasingly narrow, fewer and fewer companies participating until it's only a handful of generals pulling the market. I think July tells us that's not what's happening now, at least. And I look at it as, you know, not to be Panglossian, but this is what you want to see.
Panglossian, that's something. Hey, but I'm looking at the Russell, down 3%. Now, what we saw, like in the last few weeks, very clearly after that CPI, tech sold off and the Russell didn't. Like it was sell tech, buy small caps. I'm oversimplifying this, obviously, but that was the idea. Small caps down the 3%, even though, so underperforming now. What does that tell you?
So it's hard to look at any, listen, I would tell you it's hard to look at any one month and draw too much of a conclusion.
Fair.
But any given day, you really can't take too much from. When I look at the full month for July, and it really started around the 10th, that uptick in small cap, to see the Russell plus 10.2% total return versus the NASDAQ 100 down 1.6% total return. To me, that is such a giant historical shift. It sounds like a regime change, and it just suggests, in light of yesterday's presser and what Jerome Powell said, hey, you know, the big caps can muscle their way through and extract a fairly competitive rate on their borrowing. Small caps don't have that power. If rates begin to come down, and it's pretty, Wall Street's been wrong about this, I don't know, for 20 years. I think September is probably our best bet for a rate cut. That works to the benefit of small and mid caps much more than it does to the large caps. So maybe that's what we've been seeing in July.
Well, it's kind of where I wanted to go, Barry. It just seems like for most of my life, my investable life, this has been a tech-driven market. If you haven't been in tech, you've just been nowhere. Is that still the case here? Just, I guess, if no other reason, that's how the math works out in the weightings?
Yes, but let's step back and look at the bigger picture. I mean, I don't take a horse to work anymore. We've moved to automobiles and other forms of transit. When you look at the many, many fields that technology has touched, and I'm not just talking about AI, but everything from pharmaceuticals and drug development to surgical equipment, to the increased performance of aviation and software, and just down the road, yeah, tech is outperforming because it's tech that's driving the economic growth and driving the societal changes. You know, if you're waiting for mean reversion in leather belts and steam engines, I think you're going to be waiting for a long time. There's a reason tech is sexy. There's a reason why people are so attracted to growth. These are the companies and the products that everybody adopts and everybody spends money on. Just think about how Netflix went from what is arguably the dumbest idea ever, mailing DVDs, you know, in an envelope when you want to rent something, to that eventually morphs into online streaming, which is a billion, maybe $1 trillion industry. Every sector you can show. Just think about the impact of fracking, which is a technological development. There's a reason we aggressively embrace technology. Not only does it make us more productive, more efficient, it has a lasting impact on society. It changes who we are and how we live. We all walk around with incredibly powerful mobile computers in our pocket that the Apollo crew that went to the moon wish they had a fraction of that power.
I mean, we do. Paul's is iffy at this point, but the rest of us do. Hey, Barry, thanks a lot. We appreciate it. I have Barry Ritholtz joining us there. He has a Masters of Wealth podcast, so definitely check that out. Also, he's founder of Ritholtz Wealth Management. But such a good point. Man, you remember the DVDs Netflix mailing in? Oh my God, I thought it was the coolest thing I'd ever seen in my whole life.
Without outing this person, there is a current Bloomberg television personality that up until just months ago the DVDs.
That brain hurts in my head. Yes. Okay. The Bank of England today voted 5-4 to cut interest rates for the first time since early 2020 and signaled further reductions ahead. The Bank of England Governor Andrew Bailey sat down to discuss this with Bloomberg's Francine Lacroix, and she first asked Bailey what needs to happen for the BOE to cut rates again.
Well, we were looking for, in a sense, for sort of confirmatory evidence. We weren't looking for something to change necessarily. It was confirmatory evidence. We had that. I think we had, certainly in my own view, is we had that. But we will be looking at this framework and saying, are we seeing this sort of rather more benign comp process, which we can sort of further confirm? Or does this sort of structural issue, which is why we've put this sort of risk in, that maybe COVID, for instance, has changed some elements of the structure of the economy, which is going to make the thing more sort of resistant, if you like, to measures to get inflation down. And that's the judgment we will have to keep coming back to.
Where do you think rates settle? Is 4% restrictive?
We don't have a number on it. So what I would say is this. I think it's reasonable. Don't expect we're going back to zero, because zero was the product of huge global shocks, starting with the financial crisis, then obviously COVID as well. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Governor, the government has said it will borrow an extra £16 billion this year. Does that change the calculus around rates?
Well, I'm going to wait for the budgets on the 30th of October to see the full picture, because we always condition on an announced fiscal policy. That's what we will see at the end of October, and we'll sort of put it through the machinery at that point.
So the Fed, the ECB, the BOJ are all adjusting policy, and that's very clear, and it's trying some big change in foreign exchange markets. What are those, what of those elements are actually important to you and BOE policy?
Well, we obviously don't have any target for the exchange rates. That's all a long way in the past in terms of that sort of thinking. But obviously, the exchange rate feeds through in terms of financial conditions. We've seen some appreciation of sterling since we did the last report and forecast in May. Sterling has appreciated. We fed that through, as it were, so it changes import prices and so on. And that's how we tend to look at it, actually. I would say recently, over the last 4 or 5 years, actually, in the sort of transmission and mechanism of monetary policy, exchange rates have not played a very large role. And I think the reason for that is because we've all been facing essentially global shocks. So these are not sort of specific shocks that affect one central bank but not another. We're all in the same place, really.
That was the Bank of England Governor Andrew Bailey speaking with Bloomberg's Francine Lacroix on a rate cut, really 5-4, like really close. The idea is maybe this is a hawkish cut as we head into the next few months. In the markets, we're also paying attention to the chip stocks, right? Qualcomm, ARM, disappointing here. Yes, you had a sales beat for Qualcomm, but it's really about that super cycle and waiting for that as well as for ARM. So we wanted to get more on that with Kujan Sobhani. He's senior analyst on semiconductors for Bloomberg Intelligence. I appreciate it's a tough tape today. What were some of your broader takeaways here from Qualcomm and ARM?
Yeah, for Qualcomm, on the face of it, the earnings look solid. They also had slight beat in certain areas. But when we look under the covers, what we saw is basically we were expecting a much more robust December quarter growth, given all the commentary we're hearing about smartphone demand picking up, Apple sort of building for a stronger fourth quarter. We didn't see that in the numbers. Our guess is maybe it's more of a conservatism on their side. And there's also the headwind from the Huawei, which is we estimate about $150 to $200 million per quarter. So that's why you see the tepid reaction in the stock.
So Qualcomm, give us, just refresh us kind of who their customer base is, where do they sell chips into?
Yeah, so predominantly it's still a smartphone company. Majority of their revenues are coming from smartphones, licensing and chips. I mean, their two largest customers are Apple and Samsung. They really focus on the high-end premium segment. And over the recent years,
in order to diversify away from Apple, because there's that looming risk of Apple designing their own chip and replacing Qualcomm, they've been really doubling down on the Android ecosystem. So they still have the largest share when it comes to premium Android. So you think of any largest Android makers, right? Honor, Oppo, Vivo, Samsung, etc. They have the lion's share there.
And then for ARM, it's a similar but different story, right? Because they have that licensing part of their business, that is their business. How does that play into the smartphone versus the AI?
Yeah, so for ARM, structurally, still all the key secular drivers, which is the AI, smartphone, increasing V9 adoption in smartphones, increasing V9 adoption in data center, gaining market share in data center servers, and auto continues to stay intact. But in the near term, the broader weakness, which we have seen from all other semi players, which is in industrial, which is really in automotive, which is in your industrial IoT and networking, that sort of weighed on their near-term results. And the key sort of, I would say, lackluster was the lack of the guide of the full year guidance. They reiterated the same numbers, which we would have and investors would have liked them to sort of give an upside.
So, Kunjan, in your research or in investing in chips companies, are there two sets here, those that have exposure to AI and those that aren't that well exposed? Is that how people are looking at it?
Definitely. There's definitely a small group of AI pure play or heavily AI exposed names that have seen the most robust runs in their stock year to date. The names like NVIDIA, AMD, Broadcom, Marvell, etc. And then there's your broad-based group of semi players, still a big portion of the market, which are typically more cyclical, typically focus on a lot of these core markets like industrial and auto and networking and general purpose compute, etc.
So where does this leave Intel today? Reporting after the bell, they already announced cost cuts, job cuts. Like, this feels like a really large hill to climb. What are you looking at?
Yeah, I mean, we at the best, we're hoping slight beat to an inline that would still be good. I mean, look, from their product business perspective, right, there's a lot of headwinds they're facing. There's the market share loss in PCs and servers that's going on. On the good side is this reporting quarter should mark the bottom for their FPGA business, for their Mobileye business and NEX, and they should start seeing sequential growth coming into 3Q. So that should be good. And the second half does have the positive seasonality coming from PCs and the launch of AI PCs. So overall, the trajectory should be good from here, but we don't expect any key big surprises on the upside, given how things are going in their product business.
Boy, Intel went public in 1971. Underwriter, lead manager, Untenberg Tobin. That's even before my time. That's going way back. Intel here, Kunjan, given that its long history in Silicon Valley, one of the founders of Silicon Valley, as it relates to AI, is the belief in the marketplace that they just missed it, AI has passed them by, and it's not going to be a play for them?
That's what it looks like right now. I mean, it's a fact that they've definitely missed the first AI train. They are trying to, get back on it with their Gaudi product ramp. One of the positive thing for the sentiment could today be if they do upside their guide for this year, which has been 500 million for a while. Any kind of a major upside there should cause a healthy optimism in the stock. But that's the true fact, what you mentioned.
All right, yeah. But it's had a heck of a run so far. Kunjan Sobhani, he's the senior analyst. He covers all the semiconductor stuff for Bloomberg Intelligence. He's out there in Silicon Valley at our San Francisco offices. Pier 8, I believe it is, just right on the bay. It's just fantastic offices out there. All right, coming up, Alex, President Biden is scheduled to speak at 12 noon regarding this prisoner exchange and maybe some other items. So when that does happen, he tends to be a little bit on the late side. When that does happen, we will bring that to you. But certainly a busy day in terms of geopolitics, domestic U.S. politics, earnings, central banks speak around the world. A lot for this market to digest. So that's what we're seeing. And again, the market's selling off today.
Yeah, we're definitely looking forward to President Biden's words. This is truly the largest prisoner exchange with the West in decades. As Paul was just saying, the NASDAQ is off by about 1.5%. The S&P off by over 1%. It looks like bad news is bad news now for the market, with an ISM manufacturing data hitting its lowest since 2022, really rolling over. Joe Matthew with Balance of Power, who'll bring you all those into you live. This is Bloomberg.
politics to the world of business. This is Balance of Power. Live from Washington, D.C.
Evan is free. Welcome to the fastest show in politics. As wrongfully convicted reporter Evan Gershkovich is freed as part of a massive prisoner swap with Russia. That also includes Paul Whelan, also Kurmasheva, and other names you will recognize from this program. President Biden is just out with a statement, and he'll be speaking live from the White House in a moment. We'll bring you those remarks, along with a conversation with former diplomat Brett Bruin at the Global Situation Room. This story is breaking as we speak. Israel, meantime, is bracing for revenge still today following the killing of Hamas's leader in Iran. We'll have more on that with Michael Knights at the Washington Institute and Donald Trump doubling down on the attacks against Kamala Harris. We'll have analysis on all these stories from our signature panel. Bloomberg Politics contributors Rick Davis and Gidi Shanzano are back today. And we start, as always, as we wait for Joe Biden on Wall Street. An update right now on the markets from Charlie Pellet in New York. Hey, Charlie.
Thank you very much, Joe Matthew. And we have got stocks selling off across the board. Steep losses for the Dow, the S&P, NASDAQ. Stocks being hit as economic warnings sink U.S. yields. The S&P right now down 57 points, lower by 1%. The Dow tumbling 532 points, down 1.3%. The NASDAQ Composite Index down 271, a drop of 1.5%. The Russell 2000, particularly hard hit today, down by almost 3%. 10-year below 4%, 3.98%, with a 2-year that's yielding 4.19%. Gold down $2 the ounce to $24.45, a drop of 0.1%. And West Texas Intermediate crude oil down now by 1.1%, 77.08 a barrel on WTI. The July Fed meeting is behind us, and it is the start of a new trading month after a brutal July for tech names. We heard from Meta Platforms last night. That stock trading higher by 6.3%. And then after the bell today, it's Apple, Amazon, and Intel. But what about the broader outlook for tech stocks? Angelo Zeno is VP for Equity Research at CFRA.
We do think kind of that the tech and semi-trade will probably be choppy here over the next couple of months. Part of it is going to be kind of election-based geopolitical nature, as well as kind of the fact that they do need to digest some of the gains that they've seen, as well as kind of the valuation expansion that we've seen here.
Angelo Zeno of CFRA, and a headline from the Bloomberg Professional Service: IAG is terminating a deal with Globalia to buy Air Europa. U.S. stocks lower across the board, 1% drop right now on the S&P 500 index. Again, Apple, Amazon, Intel after the close of trading. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Charlie Pellet, thank you so much, and welcome to the Thursday edition of Balance of Power. It's the 1st of August, and we come to air today on Bloomberg Radio, on the satellite, and on YouTube with remarkable news. Having spent the better part of this week covering the bitter edges of this presidential campaign, we can tell you today that Evan Gershkovich is free. So are many others, as part of the biggest prisoner swap with Russia since the Cold War. We're going to be hearing from President Biden in just a couple of moments. The state dining room is set, and the commander-in-chief will be announcing something remarkable here that has come together over the balance of weeks as Russia has freed Wall Street Journal reporter Evan Gershkovich, as well as jailed Kremlin critics in the largest prisoner exchange with the West in decades. We have a statement from Jake Sullivan, of course, National Security Advisor at the White House. Not since the Cold War, he says, has there been a similar number of individuals exchanged in this way, and there has never, so far as we know, been an exchange involving so many countries. Indeed, this took place, the swap on the tarmac in Ankara, Turkey, included 24 people. 24 people. 16 going to the West, 8 being returned to Russia. Among them, as I mentioned, Evan Gershkovich, but also Paul Whelan. Gershkovich was arrested in March of last year on a reporting assignment in Russia. Paul Whelan, of course, was jailed in 2018, later convicted on spying charges that he denies. I have another name for you that you will know if you watch this program or listen to Balance of Power. Alsu Kurmasheva, the journalist with dual Russian and U.S. citizenship who was convicted just last month under the Kremlin's wartime censorship laws, is going to be reunited with her family if she has not been already. We brought you a conversation with her husband Pavel and her daughter Bibi on this program. They will be back together. So as we wait to hear from Joe Biden, we want to get a behind-the-scenes view on what just transpired and is still happening now with Brett Bruen, the president of the Global Situation Room, a former diplomat who brings his national security expertise to us here on Balance of Power. Brett, when you consider the scale and the number of countries involved here, this is something that must have been in the works for some time. How do you see it?
Well, it's three-dimensional diplomacy, the most complex kind of diplomacy, because obviously you're working not only on a bilateral level, trying to figure out what Moscow is willing to give and what they want in exchange, but then you've got to work these other countries as well, and they have, shockingly, their own interests, their own concerns. And so it isn't an easy effort, and hats go off to Biden's team for being able to pull this off. That being said, Joe, and I know you and I have talked about it before, I do have concerns that these kinds of exchanges also incentivize Putin and other autocratic rulers to take Americans captive and to hold them for these kinds of concessions.
That is something that I suspect Joe Biden will want to speak to, Brett, a very real concern, as are the concerns about some of the people that are going back to Russia here, including Vadim Krasikov, who was serving a life sentence in Germany for the killing in 2019 of a Chechen separatist in a Berlin park where he was shot dead. At what cost are the Americans coming home?
Well, and I think that is precisely the point, Joe, because Putin is going to be able to use this to great propaganda effect. He's going to be able to tell those who are fighting on the front lines in Ukraine, as well as others in the Russian military intelligence services, that we will, no matter what circumstances you find yourself in, be able to bring you home, and that will embolden Russian security forces to do even more. And I don't have to tell you, there are bold acts, whether it's in Germany or in the United Kingdom or in other parts of the world. Africa, as one recent example we've seen with the Wagner Group, have had a very destabilizing, a very dangerous effect on countries. And I think it's important when we take these acts, and let me be clear, we should do everything in our power to bring Americans who are unjustly detained overseas home. It's something that I did when I was a diplomat serving overseas. But I do feel that this ought to be a moment where we reflect and we reset, because Putin is not done. And other autocratic leaders are watching and saying, I can get the U.S.'s attention, I can get concessions from the U.S. if I take another American journalist captive.
Now that this group is coming home, Gershkovich, Whelan, Hermasheva, officials are talking about this as one of the few remaining areas of diplomatic cooperation between the United States and Russia. Do we need to raise the bar?
Well, look, it is a bright spot in what otherwise is a pretty bleak time for U.S.-Russian relations. And I think it's encouraging in the sense that we can still have these difficult dialogues and ultimately get to some common ground. That being said, I think Putin, again, can leverage it and point to this deal and say, the West, the U.S. is willing to negotiate in Ukraine. Just keep fighting, just keep pushing, and we will get a deal, because ultimately they will bend, they will bow to the public pressure on these issues. And I think it's also important, and Joe, if I go back to Brittany Griner, the WNBA star, there was an unprecedented level of engagement from the president, the secretary of state, the national security advisor, that we had never seen in U.S. Hostage negotiations. And what concerned me about it was that if Putin believes, if some of these other autocratic leaders believe they can get the president's attention by taking someone who has a high public profile hostage, then we're going to see more of that. And so while it's wonderful that Brittany Griner is playing alongside American teammates now at the Paris Olympics, I do worry for other U.S. sports figures. I do worry for other American journalists. And I think the caution everyone should take from this is to take much more caution when you're traveling to some of these countries.
A great conversation with a lot to think about today from Brett Bruin. Brett, thank you for being with us from the Global Situation Room here in the nation's capital. Former diplomat with us live on Balance of Power. As we stand by to hear from Joe Biden, we will when he speaks. The state dining room will be the venue, and we'll see who joins the president. The optics here will be important today. As we balance a couple of different stories here, including what's happening in Israel, bracing for revenge here, bracing for a retaliatory strike or event of some sort from Iran, following what we described to you yesterday, the twin killings, obviously the operative from Hezbollah who was behind the strike in the Golan Heights, and then yesterday the political leader of Hamas in Tehran. Pretty remarkable and bold move that has a lot of folks wondering exactly what is going to come next. The IDF is bracing and preparing for a couple of different scenarios here, and we wanted to talk about them with Michael Knights. A very delicate moment here in geopolitics. Jill and Jay Bernstein, Senior Fellow at the Washington Institute for Near East Policy. Michael, it's great to have you back. I wonder what your expectations are in the next 24 to 48 hours.
Thanks for having me. I think the expectation is that as soon as the funeral of the senior Hamas figure is completed on Friday, from that point onwards, Israel is bracing for an attack from as early as Saturday morning, and an attack that may come not just from Iran, but also from Lebanese Hezbollah, from the Iraqi and Syrian militias tied to Iran, and from the Houthis in Yemen as well. So it could be a rerun of April's Iran-Israel exchange of fire, but with a larger number of actors.
Well, this is obviously, as I mentioned, a delicate moment that could take on a couple of different forms here, and there have been questions about whether we'd see a repeat of what we saw in April. Clearly, none of the parties here, from what we've heard, at least maybe you can disagree with some of the smart analysis that we've heard in this program, none of the parties involved want to see an escalation into a regional conflict. Will that keep the tit for tat under control after whatever's about to happen?
Everybody agrees that actors would prefer not to see their home nations seriously destroyed, whether it's Lebanese Hezbollah, the Iranians, or the Israelis. And yet, you know, the players, including Netanyahu most recently, you know, take choices that do risk a broader war. And what Netanyahu, you know, ultimately decided